Hey folks, welcome you all to a new video. This is CA Ganesh Bharadwaj. So in this video, we are going to discuss the Jan 25 attempts RTP on paper 6A financial management. Now, as you all know, RTP is a very important source of preparation, especially when you are in the final leg of your for your exam preparation, because of two reasons. Number one, RTP is an excellent way to revise the entire subject because in RTP you have at least one question from every chapter. And number two, I've seen attempts where in the exam paper, certain questions are directly lifted from our RTP, right? So because of these two reasons, RTP is always a very important source of preparation, especially that particular attempt's RTP is very important for that particular attempt, right? Fine. So now in this Jan 25 edition of RTP, in your financial management management part, we've got a total of 11 questions, right? Out of that, 3 questions are MCQs, case study based MCQs. And out of those 3 questions, 3 MCQ questions, one is a comprehensive MCQ, meaning from a comprehensive case study, 5 different MCQs they have tested. And there are 2 single MCQs. Basically, there is a question, and for that question, there is only one MCQ against that, right? And you have 7 descriptive numerical problem, full-fledged numerical problem, and there is one theory question. So overall, you have 7 questions in this particular RTP. And out of this first comprehensive MCQs, comprehensive case study based MCQ, there is a first question that is from the chapter working capital management. It's an excellent question, guys, right? Please mark that as important. It's a very important question because the way in which it has been solved is very good. And of course, even in the single MCQs, there is one third question, right? Once again, that is ideally from the chapter capital structure theories, but for some reason they have they have named it as cost of capital, but it is ideally coming under capital structure theories. An excellent problem which I feel could be tricky for many students, right? Nevertheless, we will be discussing this entire RTP in detail. I'll be decoding it, and then and there I'll be explaining the concepts as well. Fine. So on that note, let us get started with the first part, division A, which is case scenarios, basically your case study based MCQs. Now, the first question, please mark this as important. There is a way in which they have calculated things, very logical, but it should strike you in the exam. That's why I'm telling you this is a very good source of practice for you. Now let me quickly read out this question. Somewhere Limited, a leading FMCG, like FMCG stands for fast moving consumer goods, right? It's a company having its current presence in more than 150 tier 1 and tier 2 cities in India. The stores are operating in the brand name of GoMart, competing with Reliance Fresh, Walmart, Big Bazaar, and other chains. Owing to the increase in demand from tier 3 cities and rural areas, it is planning for a massive expansion and is contemplating to open up additional 50 stores which will have a variety of FMCG products. Right, so basically this is a company like DMart or Big Bazaar, right? So they want to open up some additional 50 stores in tier 3 cities. Now, the CFO and his team estimate that the funds needed for massive expansion would be 200 lakh rupee per store, right? This is the financing that is required, overall financing, the capex. Such funds would be utilized for buying out space and setting up a store, buying the other required fixed assets, etc. And the central government will provide a revenue subsidy of 15% on the gross profit, provided the overall cost of capital does not exceed 10%. The government comes back and says, if your overall cost of capital is less than 10%, in that case, I'm ready to give you a revenue subsidy of 15% on whatever is your gross profit. Next, apart from the above, the CFO and his team require an estimate on the additional capital needed based for smooth running of fixed assets and its daily operation. Basically, your working capital is what they're talking about, right? Based on the market research, they have collected the other information for each store, which is as follows. Now, average sales would be rupees 120 lakhs per annum with a GP margin of 18%, which means what? 120 lakhs is the annual sales. Gross profit is 18%. So basically 82% is going to be your cost of goods sold, COGS. Next, Customers pay through different digital modes and channels, including POS systems, that is debit card and credit card. That machine will be there, no point of sale system, right? In that, they're saying which generally takes approx 9 days for the funds to get credited in the bank account, right? If you go to a Big Bazaar or D-Mart company like that, so basically what you do, you have GPay and all that, that instantly gets credited to their account. But suppose you are using a credit card or a debit card, what happens? It generally takes 9 days from the date of swipe for the company, for the store to receive the funds. This is what they are saying, right? And 15% of the customers use debit and credit cards to make the payment, which means what? Out of the total sales of 120 lakhs, 15% of this 120 lakhs happens from what? The POS, a debit and credit card system. Okay. Installing a POS system comes up with a fee of 2% on total sales to POS. Obviously, these guys, the debit card, credit card merchants, the card merchants, what they do is they will not give you the entire amount. They will deduct 2% and only the balance they will remit it to you. Technically speaking, this is a selling and distribution cost. Are you clear with this? This is basically what they do is they deduct this fee and only they will give it to you. Are you clear with this? But this is only on whatever amount is being received through the point of sales, the POS machine. Next. Being a FMCG outlet, inventories of multiple products need to be kept. Different products have different storage period. However, primarily products are classified into 3 broad categories: durable, semi-durable, and perishable. So clearly they have said there are 3 categories of stocks that they have, right? Durable, semi-durable, and perishable. First of all, understand this is not a manufacturing entity. They are basically what they are doing. They are a trading entity. They buy and they sell. That's all. They run a store, right? So they are categorizing their FGs into 3, right? Their stock and trade into 3: durable, semi-durable, and perishable. Perishable products comprise 60% of the sales, whereas semi-durable comprise 25%, and the balance is for durable products. So basically, how much is the balance? So 60 plus 25 is going to be 85. The balance 15% of the total volume is actually your durable goods. This is what they are saying. And they are also given the inventory storage period for perishable, semi-durable, and durable products. They have given. So perishable, it's going to be 10 days, right? And durable, semi-durable is going to be 30 days, and then 60 days for durable products. Are you clear with this? This is what they have given here. Perfect. So they have given the composition of the total, each of the categories of inventories, and they've also given the inventory holding period. This will be helpful for us to calculate what the respective inventories funding, the working capital amount, the stock values of each of these 3 different types of inventories. Perfect. Now, the suppliers of these products provide a credit period on an average of 30 days. This is also something that is given. This is useful for us to calculate the creditors value. Next, each store will employ around 20 personnel of a different hierarchy, right? And the monthly average salaries to staff for each store is estimated at 4 lakh rupees per month. So for all these 20 personnel put together, right? So the overall monthly average salary works out to 4 lakh rupees. The company will pay employees dues on the 1st of next month. Okay, fine. So this is also something given. Next, Summer Limited plans to keep optimum cash balance in hand as suggested by Baumel's model. So Baumel's model we have, right? There is a formula and all. Using that, they have said that is going to be the amount of cash the company is going to maintain. Excess cash balance, if any, will be invested in the marketable securities, which will generate a return of 12% per annum. The total disbursement for the year is estimated to be 1.5 lakh rupees per month. Be very careful, right? With a transaction cost of rupees 20 per transfer to the disbursement account. Perfect. Next one. The optimal capital structure with debt equity of 2:1. So basically, the optimum capital structure that you're going to maintain is 2:1. Has been proven ideal for raising the finance, and company wishes to follow the same pattern for additional funds required for each store. The trade credit can also be utilized for financing the expansion needs. Very, very important point. What it is, you will understand as we proceed into the sum. The cost of raising debt and equity for each store is as per the slab rates as under project cost. That is, if you want to raise money up to 80 lakhs KD, the cost of debt is going to be 10%, and the minimum rate expected by equity shareholders, basically they have given KE. The KE will be 12.5%. Above 80 lakhs up to 150 lakhs, 11.5% and 13%. Means what? Suppose the company wants to raise 100 lakhs. For 80 lakhs, for the first 80 lakhs, this will be the KD, this will be the KE. For the remaining incremental 20 lakh rupees, this will be the KD, this will be the KE. Are you clear with this? This is what they have given as per the slabs. Are you clear with this? Very important understanding, right? Fine. The next one, again, above 150 up to 250, 12 and 14, above 250, 13.5 and 15% they have given. It means that they have also given what it means. Up to 80 lakhs of the project cost, company can raise debt at 10% and equity at 12.5%. These two figures and so on they are saying, which means what? Incrementally it increases. Next, the tax rate applicable to corporate is going to be 25%, which means what? In this case, it's going to be before tax. You also need to adjust this for taxes. Are you clear with this? Fine. Now, what are the things that they've asked? Ideally speaking, what I generally suggest is I ask students to first read the questions, the 5 questions of MCQs, and then come to the case study. Fine. Okay. So ideally what you do is we should have first read these 5 questions and we could get an idea as to what is being asked and then read the case study. Fine. Nevertheless, first what have they asked? Calculate the optimum cash balance. Very simple. Use that Baumel's model formula, which is similar to that EOQ formula and all, and you can get this. Next, gross and net working capital for the year would be. So they are asking if the gross working capital is nothing but sum total of all the assets. Net working capital is current, sum total of all the current assets. Net working capital means current asset minus current liability. Perfect. Then the amount of total funds needed to set up a store. Basically, what is this? This is going to be your total amount required. That is your capital expenditure, right? That is for all your fixed assets plus your working capital, both put together, the total funds. Next, calculate the overall cost of capital for raising the additional funds. This is what is asked for. And finally, the amount of revenue subsidy granted by the central government, right? 5 aspects of this particular question is being asked. Now guys, first part of the question, they've asked us to calculate the the optimum cash balance. It's very simple. So as per William J. Bobel model, so we have this formula for calculating the optimum cash balance. It is root of 2AT divided by O. A stands for the total annual cash disbursement, right? Not monthly, annual cash disbursement. T stands for cost per transfer and O stands for opportunity cost. Now, all these 3 figures are given in the question in that single paragraph. Please have the question with you. In that single paragraph, they have given that, one second. Yes, somewhere limited plans to keep optimum cash balance. In that column, in that paragraph, if you see, so they have given that monthly cash disbursement is going to be 1.5 lakh per month, correct? Which means per annum, how much is it going to be? 1.5 lakh into 12, that is going to be 18 lakhs per annum, right? So A is going to be 18 lakhs, right? T, cost per transfer, it is given as 20 rupees. And O, what is the opportunity cost? So if I am not actually, whatever excess amount, if I'm not maintaining it as cash in bank, what happens is the excess amount will ideally be, what happens? It can be invested elsewhere in marketable securities, which gives a return of how much? 12%. So it's going to be 0.12. Are you clear with this? So if you apply this formula, root of 2 into 18 lakh into 20 upon 0.12, you get that the optimum cash balance has to be how much? 24,495, which is ideally option number D. Are you clear with this? The first leg of the question is fairly simple. It's just a formula application and you will get it. But remember, this figure is going to be the cash amount that they are going to maintain, which means what? When you are preparing that working capital statement, the cash balance that is required to be maintained, you can get the figure from the first step. Are you clear with this? Now, the second part of the question, what have they asked? They have asked us to calculate the gross working capital required and the net working capital. Gross working capital means what? Sum total of all the current assets. Basically, why are we calculating this? We are calculating this to find out how much money needs to be blocked in terms of current assets. Are you clear with this? Right? So, gross working capital is a sum total of total current assets, and net working capital means the gross working capital, that is your total current assets minus current liabilities. We know this. Now, if you see, ideally speaking, in your current assets, what will be there? In your current assets, you have stock, correct? Stock means what? 3 different types of stocks. You have durable, semi-durable, perishable. Clear with this, right? Apart from this, what will you have? You have trade receivables. Sir, how trade receivables, sir? Ideally speaking, the company runs in a proper cash model. But however, if they use point of sale devices, there is a 9 days gap is there, no? Right? So that ideally the 9 days equivalent cost of sales, that is the fund that gets blocked there, that needs to be coming under, that needs to come under your trade receivables. Are you clear with this? And apart from that, there is only one more item called as cash in bank. Are you clear with this? Simple. This figure we have already computed 24,495, which is a part of the first part of the question. Are you clear with this? Ideally speaking, here we just need to calculate these two figures, right? Subtract from this current liabilities. Two current liabilities are there. Number one, trade payables, they have given it, and number two, some outstanding salaries they have given. They are paying it 1 month later, that is in the first of next month. So that is also one more thing, as simple as that. So first, what have I done here? I have listed what are the line items in your working capital. Now let us get into calculating each of these figures. And guys, this entire sum has been solved under cash cost basis. That is basically what the amount that gets blocked into the business. The amount that gets blocked into the business. Fine. Now what happens here? The first one, calculation of FG inventory. All the three, durable, semi-durable and perishable, all the three are FG only, because this is not a manufacturing entity for you to have RM, WIP and FG. There's only FG. Now guys, if you look at it, now in this company, you tell me overall, what is going to be the sales? It's given in the question. 120 lakhs per annum is the sales, and 18% is the gross profit margin, which means 82% is going to be your cost of goods sold. So the annual cost of goods sold is going to be how much? 98.4 lakhs. Are you clear with this? Now what is going to be the respective FG inventory? It's going to be the cost of goods sold into the inventory holding period divided by 360, correct? Why? If 98.4 lakhs is the cost incurred for 360 days, right? How much will be the cost incurred for the respective FG storage period, inventory holding period? Now, what is the inventory holding period? It depends on which inventory you are holding. There are three different types of inventory. You have durable, semi-durable and perishable. Are you clear with this? You just need to calculate the figures here, because what gets blocked in my stock is going to be my cost of goods sold. Are you clear with this? So what we need to do, very simple. So in case of perishable, so perishable, semi-durable, durable. Perishable, overall we saw that 60% of my total sales comes from my perishable products. So basically cost of goods sold of 98.4 lakhs on that 60%, this is going to be the cost of goods sold with respect to perishable product, correct? Right? If that is for 360, how much is it going to be for 10 days? Because it gets blocked only for a period of 10 days, it is going to be 1.64 lakhs. Similar calculation, semi-durable, 98.4 lakhs into 25%. This is going to be the cost of goods sold with respect to semi-durable product, but that figure is for 360 days. How much is it for 30 days? You get 2.0405 lakhs. Similarly, for durable, it's going to be 98.4 lakh into 15%. That is going to be the total cost of goods sold for the, incurred for durable products. That if that is for 360 days, how much is it going to be? 60 days, it's going to be 2.46 lakh. You add the 3, you get a total of 16.15 lakh, which can be populated here as 16 lakh 56 lakh 15. Are you clear for this? As simple as that. Next one, trade receivables, guys, very important. Now with respect to trade receivables, what is the amount that gets blocked? Ideally speaking, it is not just cost of goods sold, it is cost of sales. Now sir, how is the difference here, sir? Any specific cost they have given? Yes, that 2% of the fee, whichever the point of sale machine that they deduct, no, the 2% collection fee that these guys charge, that should also be considered. Look at this. Since the company is into FMCG industry, sales are always on cash and there is no credit given to any customer. However, as mentioned in the case study, the company will get credit in the bank account only after 9 days for those customers who pay through the POS machine. Right? It means the company's funds get blocked for 9 days. What funds? What funds? Those funds that gets routed through the POS machine. Correct? Now, with respect to the point of sales, first you tell me, how many people use this point of sale machine? Now they have given in the question, 15% of the customers use debit and credit cards. Correct? So now, technically speaking, how much is the total sales in a year? 120 lakhs. But ideally speaking, not the entire 120 lakhs get blocked. Why? Because out of this 18% is my GP margin. So technically speaking, on this, only 82% gets blocked. Correct? Right? This is going to be the total cost of goods sold in a year. Right? Now, that too not the entire cost of goods sold is getting blocked, because out of this only 15% of the customers use this point of sale machines. Correct? Are you clear with this? So how much is that going to be? 120 lakhs into 0.82, that's going to be 98.4. right, on that 15%, right? Now, is that the only component that gets blocked? No. Now, read the question. They have said there is the POS system comes with a fee of 2% on total sales. So, how much are these POS guys charging me on the sale value of 120 lakhs? Here, not the cost of sales. Whatever is the swipe amount, you tell me what is the amount that they are going to deduct on this 120 lakhs, right? Only 15% of the overall customers are availing this facility. Are you clear with this? Right? Only 15% of the people are availing this facility. Are you clear with this? Right? On that 2% is the fee that these guys charge. So technically speaking, the total cost of sales incurred in respect of those customers availing the point of sale facility in a year is going to be 15.12 lakh. I am repeating, 15.12 lakh is the cost of sale incurred in respect of those 15% of the total customers who use the POS machine. Are you clear with this? Now, this 15.12 lakhs is the cost incurred for the entire year. How much is it going to be for 9 days? 15.12 into 9 by 360, you get 0.378 lakhs. Are you clear with this? Extremely important. This is where students make mistake. You might have considered this, but the transaction fee is something that many students miss out. So transaction fee is it is in relation to financing item. It's not financing and all, guys. Very simple. It's a part of working capital only. Look, whenever a customer swipes on a POS machine, what happens? These guys are deducting 2% and giving you. That's basically a sales related expense. And for debtors, the debtor value gets valued at cost of sales. Cost of sales include was cost of goods sold plus AOH plus SOH and all. This is ideally and selling and distribution overheads. Are you clear with this? This is something that students generally tend to miss out on. Please watch out for this, right? And I am expecting this adjustment to be tested in your Jan attempt. If not in Jan 25 attempt, in May attempt, at least it will come. So please watch out for this, right? Very simple. Just be aware. That's about it. Very, very simple, right? Calculation wise, it's all the same. So now it's going to be 37,800. Are you clear with this? And anyways, the cash and bank balance is already calculated. So you add up the three, you get the gross working capital. Are you clear with this guy? Next one, trade payables. Trade payables, how do we calculate? So for trade payables, once again, what gets the total purchases is the figure using which we value the trade payables. How will you calculate the total purchases? Cost of goods sold plus closing stock minus opening stock. Now in this case, they are saying they are planning to open the store for the first time, which means opening stock will be nil. Closing stock, sir, how much is it? We just valued the closing stock right now. Closing stock value is going to be 6.15. How do we know? At any given point of time, the company is going to maintain 6,15,000 rupees of stock. That's what is given, right? And cost of goods sold, we know how to calculate. It's going to be the total 120 lakhs into 82%, right? That's going to be 98.4 lakhs. Are you clear with this? So basically, the total purchases is going to be 98.4 lakh plus 6.15 lakh minus 0. This is the total annual purchase of 104 lakh, 104.55 lakh. This is going to be the total annual purchase. Are you clear with this, guys? Right? Now what happens? This is the total purchases made in a year. But what is the credit period these guys are ready to give? You can just see in the question. 1 second. Yes, it's mentioned in the question. They are giving a credit period of 30 days, right? The suppliers of these products provide a credit period of average of 30 days. So basically, if this is for the entire year, how much is it going to be for 30 days? 104.55 divided by 360 into 30. So you get that the trade payable at any given point of time is going to be 8.7125 lakhs. Are you clear with this? And you can just go and plug the figure. Technically speaking, trade creditors is nothing but what? It's an indirect way of funding only. Are you clear with this? Not in cash, but in kind. They supply the goods today, but they are willing to accept the money later on. It's an indirect way of funding only. Are you clear with this? So now you just go and populate the figure here. It's going to be 8,71,250. And finally, there is one more thing, outstanding salaries. And that's also given in the question. Salaries are paid on first of the next month, thereby meaning it has been outstanding for a period of 30 days, assuming the salaries accrue evenly throughout the year. And now they have given per month, the salary is going to be 4 lakhs. Correct? So in a year, how much is that going to be? That's going to be 4 lakh into 12, 48 lakh. If 48 lakh is for 360 days, how much is it going to be for 30 days? So at any given point of time, there's going to be an outstanding salary of 4 lakh. This is also an indirect way of funding. How? They provide the services now. That is basically the staff. They provide the services today, but they accept the payment 1 month later. That's the reason why it is a current liability that we reduce it. So that it goes on to reduce my total required funding of working capital. Are you clear with this? We've seen all this in our regular lectures, but here, once again, I'm just recapitulating wherever required. So now it's going to be 4 lakh rupees here. So the total current liabilities is going to be 12 lakh 71,250. Net working capital, you'll be surprised, it's a negative figure of 5 lakh 93,955. Why do we have this? See, I require a gross working capital of 6,77,295. However, in the course of this operating cycle itself, I am actually getting more figure. I'm getting more funding, which is actually bundled in my operating cycle itself. So I'm getting more of 12,71,250. So how much extra am I getting? It's 5,93,955. This is the extra amount of funding that is actually naturally bundled in my routine course of operation. This is how you need to read working capital. Are you clear with this? So finally, what is going to be your answer here? The answer is going to be option A, that is gross. Your gross working capital, that is the total current assets, is going to be 6,77,295, and the net working capital is going to be 5,93,955. That's what is being mentioned here. Look at this. So it's going to be option number A, is it? It's going to be option number A. Are you clear with this? Fine. So that's about the first two parts of the question. Yes, that's about the first two parts of the question. Now, what is the third part of the question? So what have they asked in the question? The third part, the total amount, the total funds needed to set up a store. Very simple. In the question itself, they had mentioned how much is the total. They have said the gross for the fixed assets requirement. How much was it? 200 lakhs. Working capital, ideally it's not a positive figure, it's actually a negative figure. So you net off these two, you get a net total capital requirement of 194.0605. Basically, if you look at your balance sheet, right? So what have they asked? They need, so basically, what is the net amounts required? The net capital employed is nothing but, can I say, fixed asset plus current asset minus current liabilities, right? Or in other words, can I say it's nothing but fixed asset plus working capital? That's exactly what we have done. 200 lakhs plus negative of 593,955. So the net total capital required is going to be 194.0605 lakhs. Are you clear with this? That's going to be option number A. So the total funding required is going to be 194.0605. Are you clear with this? Fine. Next. The overall cost of capital for raising this additional funds for setting up each store. So now I need to raise how much? 194.0605 lakhs, right? So what is the overall cost of capital required? What is the overall cost of capital for me to raise this extra 194.0605 lakhs? This is what they've asked. Guys, very, very interesting calculation. Now look at this. This is where I said, I asked you to underline one point, and I said the relevance of this we will see when we are solving the question. No, the time has come right now. Now, ideally speaking, the company requires 200 lakh rupees for what? For its fixed assets. And then they are saying some 5.93 lakhs of working capital, actually saying is a negative working capital. Now, can we adjust it to? Normally, no. These two can't be adjusted and say the net funding required is 194. For the purpose of calculating cost of capital, we can't adjust it to. We should not adjust it to. In fact, during our lectures also, I have taught you cost of any long-term sources of finance should be completely ignored for the purpose of working capital. So for the purpose of cost of capital, I have told you this. However, it's an exception in this question. Why? They have said, look at this. Ideally speaking, overall cost of capital, we should have calculated for 200 lakhs. But in this case, we have to calculate only for 194.06 lakhs. Why? Because we are adjusting the negative working capital. Sir, is it allowed, sir? Generally not allowed, but specifically mentioned in the question. Where, sir? Read this line. Trade credit can also be utilized for financing the expansion needs. This one line will make all the difference in your calculation. Are you clear with this? Extremely important, guys. This is something, once again, I feel students can miss out on. In that case, the net funding, see, this answer will not change because of this line. Total capital needed, this is okay, fine. However, for the purpose of calculating cost of capital, right, we are going to consider 194.06, or whether should we consider 200? Normally 200. However, in this question, it is going to be 194.0605. Reason mentioned in the question. I specifically asked the question. They are saying that trade credit can be used for funding your expansion needs. Hence, we are doing it. Now, look at this. This is what is given here. Samvar Limited would require financing of 194.0605 lakhs from debt and equity, and not 200 lakhs as 200 lakhs, since the trade credit is also considered to be a source of finance as mentioned in the case study. Because it is mentioned in the question, I am adjusting. Else, cost of capital is always focused only on long-term sources of finance. It is only talking about your long-term funding requirements, not your working capital requirements. Let's be very, very clear about that, right? Furthermore, the overall cost of raising the additional fund from each store of 194.0605 needs to be calculated slab wise. Now, they have given, look guys, in the question they have given, for the first 80 lakh, there is different KD, KE. For the next, between 180, more than 180, less than 150, different KD, KE. Then beyond that, different KD, KE, which means for each and every slab, there is a different KE, KD that needs to be computed separately. So now, totally guys, totally you tell me, how much is the fund the company needs to raise? 194.0605 lakhs. Correct? Now, for the first 80 lakhs, right, the KE and KD is different. It's given 10 and 12.5, right? Then above 80, but up to 150, meaning what? For that extra 70 lakhs, right, there is a different KD, different KE. Are you clear with this? Right? So till now, how much has happened? Till now, how much we have raised? 80 plus 70, 150. How much more we need to raise? They have given the third slab is 150 up to 250. Right? So basically, the third slab, our thing ends at third slab. How much extra we need to raise? 150 we have raised till now. We need to raise a total of 194.0605. The extra 44.0605. For this 44.0605 lakhs, this is the KD and this is the KE. Are you clear with this? Now, for each and every slab rate, we need to calculate the cost of capital separately. And they have given in the question, irrespective of anything, the company always raises money in the proportion of 2:1, 2 for debt, 1 for equity. So for the respective slab, we know the KE/KD. For the respective slab, we know the weights also. You multiply the two. So KE/WE and KD/WD, that is the cost of the respective capital multiplied with the weight of the respective capital. You get the KO for each and every slab, right? With that, you get the total cost for the respective amount divided by the total capital. I will walk you through, nothing to worry. But one more thing that you need to understand, in this case, they have given cost of debt as 10%, 11.5% and 12% and 13.5%. They have given these slab rates, and below they have given tax rate. Now, in my opinion, the question is not clear. In my opinion, there are two alternative solutions possible. You can assume that this KD is already adjusted for tax. However, in this question, institute is taking an assumption. They have not mentioned it clearly, but they have taken an assumption that this is ideally an interest rate before taxes. So from this 10% adjust into 1 minus T. From this 11.5 do 1 minus T, or in other words, tax adjustment they are expecting you to do over and above this. Sir, how will I know? Ideally, the question should have been clear. If not, suppose you are not taking it, please write a note in this regard. But okay, fine. This is an MCQ. You can't write a note. Now I get it. Fine. So if suppose this question comes in, maybe you can take it as your tax rate needs to be adjusted, because generally when they are mentioning cost of debt, KD is ideally after adjustment of tax. Ideally speaking, I think this is one lacuna in this question. Ideally, if they are giving cost of debt, it should be after adjustment of tax. If it is before adjustment of tax, they shouldn't have mentioned it as cost of debt. They should have just left it as interest. Correct? In that case, you would adjust. But somehow, I think the wording is not that great. So they are doing a tax adjustment here. So what they have done is, look at this. For irrespective of which slab you are in, always the proportion of debt is to equity is going to be 2:1 as given in the question, right? So 2/3 and 1/3. Debt component is going to be 0.66666. Equity component is going to be 0.3333, right? KD, so in the first slab rate, what it is given? 10%, right? So they have done 10 into 1 minus 0.25, right? This is basically they have done a tax adjustment, which I just told you. So KD comes out to 7.5 percentage. KE given in the question 12.5, right? So now the KO for the first 80 lakhs, how much is it going to be? 0.666666 into 7.5 plus 0.333333 into 12.5. If you do, you get 9.167%. Or in other words, for the first 80 lakhs, the overall cost of capital is 9.167 percentage. So 80 lakhs into 9.167 percentage, ideally speaking, for the first 80 lakhs, what is the total cost in amount that you are incurring? You are incurring 7.3334 lakhs. Are you clear with this? Right? You just multiply and keep it there. Sir, why are we doing it like this? I will walk you through. You need not have to worry. Similarly, for the second slab of 70 lakhs, for the next 70 lakhs, what happens? The weight of debt, weight of equity remains to be the same. However, what happens? KD and KE alone changes. Here it's 11.5 into 1 minus 0.25. It's going to be, KD is going to be 8.625 percentage. KE is going to be 13.5 percentage. So here the KO for the next 70 lakh rupees is going to be 0.666666 into 8.625 plus 0.33333 into 13.5. It is going to be 10.25 rupees to 10.25 percentage. Meaning what? For the next 70 lakh rupees, right, the overall cost I'm incurring is 10.25 rupees. So 10.25 rupees into 70 lakh. So ideally speaking, the exact overall cost of finance that I am incurring for this 70 lakhs is going to be how much? 7.175 lakhs. Similar calculation for the next 44.0605 lakhs. That is the third slab. So how much is this? The KD and the weight of debt and weight of equity remains to be the same, right? Well, the cost of debt, how much is it? 12 into 1.1 minus 0.25 gives you 9%, and KE is going to be 14 percentage. So the overall cost of capital for the remaining 44.0605 lakhs is going to be 0.6666 into 9% plus 0.3333 into 14 percentage. That gives you how much? 10.6666 percentage. Or in other words, for the amount, for every rupee that you have raised over and above this 150 lakhs, that is for each rupee in this 44.0605 lakhs, the cost incurred was how much? 10.667 percentage. If you want to arrive at the total cost of finance for this 44.06 lakhs, it's going to be 44.0605 lakhs into 10.6667 percentage. It's going to be 4.7. Or in other words, if you add up these three, right, that is going to be the total cost in terms of figures. That is going to be the total cost you incur with respect to the fundraising, correct? 7.334 plus 7.125 plus 4.7. This is going to be the total cost of finance, the total finance cost you incur to raise how much amount? To raise a total amount of 194.0605, right? So in that case, what is going to be your overall cost of capital? Take the total finance cost divided by the total funds. You get how much? The net percentage that you get is going to be 9.9. Are you clear with this? When slab rates are given, this is how you compute. In fact, in our regular lectures, we have done one question similar to this, but it is not in the same context. We did that for marginal cost of capital, weighted marginal cost of capital. But anyways, the calculation, the way in which you calculate is going to be the same. So what happens? Your overall cost of capital is going to be 9.9%. Are you clear with this? The option is going to be option number C. Fine, guys. So it's going to be option number C. Fine. Look at the calculation that's involved here. It's not a very direct sum, but it requires some calculations. Definitely requires some calculations. And one more thing regarding that KD, the cost of debt, even I don't have an answer to that. Basically, sir, should we take pre-tax or post-tax? Ideally speaking, when KD is given, even if I were a student, I would assume that it is already adjusted for tax. But I don't know why they are adjusting it for tax once again. And this being an MCQ question, you won't even have a choice of writing a note and all, because at the end of the day, you just need to take an option. So even I don't have a proper way out for this. But this is how it has been done. So let's take it with a pinch of salt, and that's about it. So I'm just explaining how they have done it, but this part alone is definitely a lacuna, which I feel in the exam it will be clearly mentioned. So don't worry too much about the things which are not in our control. Okay, fine. And finally, what have they asked? Calculate the amount of revenue subsidy granted by the central government. So how much were they given? In the question they've given revenue subsidy is going to be 15% on the gross profit. So read the question here. They have said the revenue subsidy will be 15% on the gross profit if the overall cost of capital does not exceed 10%. What is the overall cost of capital? 9.9. Just to escape. So the company is the company eligible for a subsidy? Absolutely is. So how much will that subsidy be? 120 lakhs is the total sales. On the gross profit they are saying, so into 18 percentage, and on that 18 percentage, how much are they going to give? They're going to give a subsidy of 15 percentage, right? Into 15 percentage. It's going to be 120 into 0.18 into 0.15. It's going to be 3.24 lakhs. That's going to be the amount of revenue subsidy, right? That's going to be the amount of revenue subsidy. So it's going to be 3.42 lakhs. Are you clear with this? Now, just imagine, suppose in this cost of capital, right, you did some mistake and you got a figure which is beyond 10%. You got a figure which is beyond 10%. Now, what will happen? If it exceeds 10%, you will not get any kind of subsidy. The answer will be 0, right? So, if you have got a wrong answer in option 4, option 5 is also taken for a toss. Look how they have interlinked. So to make sure that if you get, you will get both correct. If you get one thing wrong also, the other one is also taken for a toss. Are you clear with this? This is the comprehensive case study based MCQ, the first question. Please mark this as important. They have linked both, they've linked both working capital, predominantly it's a working capital sum. Little bit concept of cost of capital was also being inserted here, and one unique adjustment we saw that the trade creditors, that is basically your working capital negative figure, can be adjusted against your gross fixed asset requirement, and the net amount alone gets funded. Ideally, that should not be the case. I've taught you guys it shouldn't be the case, but since it is given in the question, we have actually taken that. Are you clear with this? And that's about the first question in your integrated case study. Now, let's move on to the next one. Let's quickly move on to the next one. The next question. The cost of capital of the firm is 12%, and its expected EPS at the end of the year is going to be 20%, right? Sorry, rupees 20. And its existing payout ratio is 25%. The company is planning to increase its payout ratio to 50%. What will be the effect of this change on the market price of the company as per Gordon's model if the reinvestment rate of the company is going to be 15%? Now, what you need in this particular question, just a minute, I'm also opening the question here. Now, what do you need here? Ideally, the cost of capital is given here. Now, in the absence of any other information, you can take this as KE, because this is a dividend, exclusive dividend based question, right? Nothing is given. You can assume that it's an all equity entity. Cost of capital is equal to your KO is equal to KE. You can assume that. Fine. Now, how do you arrive at the market price of a share? As per Gordon's model, D1 divided by KE minus G. Correct? Now, in this question, is the growth rate given? No, they have not given you the growth rate. Can I say G is equal to BR? B stands for retention ratio. R stands for what? R stands for your rate of reinvestment, right? So currently you tell me what have they given? So the existing payout ratio is 25%, which means how much is the retention ratio? 0.75, correct? And the rate of return on reinvestment, how much is that? 0.15. So how much is my growth rate? 0.75 into 0.15, it's going to be how much? 11.25%, right? So currently my G is going to be 11.25%. At present, I'm telling G is equal to 11.25%. KE, how much is it? KE is given in the question as 12%, right? So KE is how much? 12%. G I got 11.25. D1 can I calculate? Yes. They have said expected EPS at the end of year 1 is 20. That is the EPS. And the payout ratio is how much? 25%. So 25% on 20, that is 1/4 of 20. How much is that going to be? That's going to be 5. So now we've got this figure. So D1 is 5 divided by KE 12% minus G, it's going to be 11.25%. So how much is the current market price of the share? Current market price of the share is going to be 5 divided by 0.75%. That's going to be 666.666666, right? Look at this. Yes, this is exactly what they have done. Current market price is going to be 666.667. So the current D1 is going to be how much? 20 into 25 percentage, 5 rupees. G is equal to B into R. We've got this figure. So current NPS is equal to how much? The same formula. D1 divided by KE minus D. Gordon's formula, right? We've derived all this formula in our lectures. Yes, it's a derivation which is very, very logical. It is nothing but a time value of money concept only. It's logically derived. Your geometric progression formula and all, right? Sum of infinite cash flows. So that's what it is. So your current price is going to be 666.6667. Now, what have they given in the question? Now, the company is planning to increase its payout ratio to 50%. What will be the impact of this change in the equity price in the MPS, in the market price of the share of every single equity share? Now, how will you do this? Now they have given what is going to be the new D1. The new D1 is going to be, so 20 rupees is the EPS. The payout ratio alone is going to be 50%. It is increased to 50%. So D1, that is your new EPS into your payout ratio, is going to be how much? 10 rupees, right? Now, what is going to be the new G? G is equal to B into R. So B is going to be your retention ratio. 50% is the payout ratio. So obviously 0.5 is going to be, the remaining 50% is going to be your retention ratio. So 0.5 into R is given in the question as 0.15. So now my G is going to be 7.5%, right? Right. So now what is going to be my new MPS? New MPS is equal to D1 divided by KE. KE is already given in the question. How much is that? It's going to be 12%. That is not going to change. Minus G. How much is G? 7.5%. So 10 divided by 12 minus 7.5. So 12 minus 7.5% is going to be 4.5%. So 10 divided by 4.5%. 10 divided by 4.5, 0.045%. That's going to be how much? The new MPS is going to be 222.2222. So current NPS is going to be 666.6666. New MPS is going to be 222.2222. The difference between that is going to be 444. Are you clear with this? That's going to be whatever option they have given. Option number B. Guys, it's fairly a simple question. No great, kind of no tricky adjustments and all involved here. Pretty much straightforward. You just need to apply the Gordon's formula and do it. So all you need to do is you need to know that this formula you need to know, and you need to know that G is equal to BR. If you know these two formulas, you can just directly do the sum, and we have derived all these formulas and seen. So there is nothing great here. It's fairly simple, right? Now let's move on to the next question. Question number 3. Guys, mark this sum as important. Extremely important. Very, very good question. It's a very good question. Solid question. Please mark this as important. And this is ideally not a cost of capital chapter. This ideally, in my opinion, this is what it is. It should be categorized as capital structure theories. Capital structure theories. That's where this question needs to come. But anyways, let's quickly get started with this. Now, Abhi Limited is an all equity financed company, right? It is considering to replace rupees 275 lakh worth of equity shares with 15% debenture. What they are saying, currently the company is unlevered entity, full all equity. Now they are saying they are planning to buy back, or in other words, whether it's buyback or not an issue here. So of the total equity, 275 lakh rupees worth of equity alone, what they are planning to do is they are planning to remove that by issuing debentures to the equity shareholders. Are you clear with this? This is what they are saying basically. Or they will buy back this 275 lakh rupees worth of equity shares, and rather instead of this 275 lakh worth of equity, they are going to introduce 275 lakh rupees worth of debenture. This is what they have mentioned. Next. The current market value of the company is 1750. Unlevered entity value is 1750 with a cost of capital of 20 lakhs. Current KO is 20. KO is equal to KE. Why? Because there is only one source of finance here. It's an all equity entity. Are you clear with this? Right? Next. The future EBITs are going to be constant and entire earnings are going to be distributed. Perfect. The corporate tax rate can be assumed to be 30%. What will be the new cost of equity the firm? This is a question that they have asked. Excellent question, guys. And the best part here is, even if you look at the solution, you might not be able to understand it fully. Now, What have they given here? What have they given here? They have given that currently the company has a market value of how much? 1750, or in other words, currently this is an unlevered entity. Correct, guys? Right? Unlevered entity means what? In that case, the value of the firm is equal to value of equity, because equity is the only source of finance here. Correct? Right? So how much is the value of equity? The value of equity currently unlevered firm is going to be rupees 1750 lakhs. Correct now? Right? Now, what have they mentioned? Cost of capital is 20 lakhs, or in other words, KO is equal to KE, because it's an unlevered entity, right? Is equal to how much? 20% is what they have given. Now you tell me, guys, can I say value of equity is equal to earnings available for equity shareholders divided by KE? Correct? No, this is a very logical way of doing it, right? This is the formula for it. Value of equity is equal to EFE upon KE. Now, I have value of equity 1750 is equal to EFE divided by KE of 20%. Or can I say the earnings available for equity shareholders is equal to 1750 into 0.2. How much is that? Can I say 350 lakhs? Correct, guys? Right? Now, since this being an all equity entity, so what is the format of your your profit income statement? It's going to be EBIT minus interest, that gives you EBT, minus tax, that gives you EAT, right? Minus preference dividend now is not here, so this is also going to be equal to EFE, right? In this case, EFE is going to be 350 lakhs, right? So 350 lakhs, tax rate is given as how much? The tax rate is given as 30%, right? So basically, if my EBT is 100, right, my tax is 30, my EAT or my EFE in this case is going to be 70. So if my EFE is 350, how much should be my EBT? It's going to be 350 lakhs divided by 70 into 100. You can reverse work and calculate EBT, right? Since there is no interest, this EBT itself is equal to EBIT. Are you clear with this? I'm just giving you the approach to the solution, right? So now this is what they have done here, but they haven't mentioned any of this. Look at this. Current PAT they have mentioned is 1750 into 20%. How they have arrived at this? Look at this. Profit after tax is also equal to earnings for equity shareholders. How can you say this? Because there is no preference dividend. So profit after tax minus preference dividend is equal to earnings for equity. Correct? Since there is no preference dividend, I can say that EFE itself is equal to PAT, but they have not mentioned all these details here. Next, sir, how can you say that this is 1750 into 20%? 1750 is ideally nothing but value of equity. 20% is nothing but KE. So I can say, just now I proved and showed it to you, EFE is equal to value of equity multiplied by KE, right? We have this particular formula. So with this, you can arrive at the value of 350 rupees. Are you clear with this? This is going to be what? My current profit after tax, right? Now, if 350 is profit after tax, how much is my profit before tax, right? That is going to be 350 divided by 70 into 100, or in other words, 350 divided by 0.7, that gives you 500. Are you clear with this? Are you clear with this? Right? Now they have mentioned in the question, the current EBIT is also going to be equal to my future EBIT, right? And obviously you all know that EBIT is a figure that will not change with when your capital structure is changing, because that is actually operating profit, right? EBIT is nothing but operating profit. Operating profit will not change when your sources of funding are changing, right? So that is also same as your future EBIT. They have got this figure. Are you clear with it? Now, in future, this 500 lakhs will continue to be what? This will continue to be your future EBIT, right? Profit before tax, or earnings before interest and tax, right? Or EBIT, right? Now what happens in future is that out of my entire, the capital employed or my capital structure, 275 lakhs is now going to become what? Sourced through debentures, right? So ideally speaking, so EBIT minus interest will be EBT, correct? Now this 500 lakhs is going to be my EBIT, right? Now from that I need to reduce interest. How much will be the interest? 275 lakhs into 15%, right? If you reduce the interest, that will be your future earnings before tax, EBT, right? Now on that, if you apply 70%, that is after reducing 30% of tax, you get the future profit after tax, and this will also be your earnings for equity. Why? Because profit after tax, earnings after tax minus your preference dividend will be your earnings for equity shareholders. There is no any preference dividend and all. So now obviously this is going to be your earnings available for equity shareholders, correct? Now what have they asked in the question? They have asked us to calculate the KE. Can I say KE is equal to earnings for equity divided by value of equity, right? Now earnings for equity, obviously they have asked for the KE value after the after this restructuring happens. So we've got the earnings for equity after the restructuring happens, that is 321.125. now we need to arrive at the value of equity after this restructuring happens. Now how can we calculate that? Now this is where we need to use that formula that we have seen. The value of levered firm is equal to value of unlevered firm plus debt rate into tax plus debt into tax rate, right? The derivation of this formula also we've seen, this is nothing but your time value of money formula, which I derived and showed it in the class, right? So basically currently the firm has a value of how much? 1750, right? This is going to be the value of unlevered entity plus the value of debt 275 lakhs into tax rate. So you get the value of the entire firm, a levered firm. The new value of the company is going to be 1832.5 lakhs, right? From the entire value of the firm, reduce the value of debt, which is given as 275 lakhs, you will get the value of equity. See how much reverse working is here, right? And finally, now you have the value of equity, now you have the EFE upon value of equity, that is 321.125 divided by 1557.5 gives you the KE of 20. And that's about this question. Now guys, I'm summing it up once again because this could be a little confusing, especially if you have not studied. If you have skipped this chapter, capital structure theories and all, it's going to be very difficult. That's why I said ideally this question is not from cost of capital, it is from capital structure theories, right? So basically what they have done, they have given the current one second, yes, so they have given the current value of equity, they have given the current KE. With that we calculated the earnings for equity, which is also your profit after tax. With that what we did, we reworked and we calculated the EBIT. Now EBIT is nothing but operating profit that remains to be the same irrespective of your capital structure, whether it's levered or unlevered. EBIT is nothing but operating profit before all the finance cost, right? So this will continue to be your future EBIT, right? But in future what happens, there is a leverage, that is there is going to be a debt component. So my EBT will be different, that is EBIT of 500 that continues to be the same minus my interest 275 into 15%. This is going to be my future EBT, right? On that, if you remove the tax, this is going to be the future EAT, earnings after tax, that is also going to be your future EFE, right? Now in future, that is going to be a levered entity. What will be the total value of the firm? It's going to be value of unlevered entity plus debt rate into tax. So using this formula, we calculate the total value of the levered firm. From that you reduce the value of debt, which is 275 lakhs, you get the value of equity. So finally KE is nothing but the new EFE of the levered firm divided by the new value of equity of the levered firm. This EFE is 321.125 and the value of equity right now after leverage is going to be 1557.5. So you divide the two, you get the new KE. Option answer is going to be option. Are you clear with this? Right? So this is exactly what they have done in the question. The logic that goes behind this, extremely important, right? One second. Yeah. So the logic that goes behind this is extremely important. And I felt that this was one little tricky question, which you might find challenging. So this is the reason why I took some extra time in once again recapitulating. So with this, we have completed this question number 3. Now let's move on to the next question. This question number 4. Now from now on, the remaining sums are all descriptive based question. So question number 4 is on the chapter ratio analysis. This is pretty much a straightforward question, right? And this is about missing figures. Now let's quickly get started. Vardhaman Limited gives you the following information related for the year ending 31st of March 2024. So current ratio is given as 3:1. Loan funds to owned funds ratio. Technically speaking, this is nothing but your debt upon equity ratio, right? It's going to be 1:3. Then gross profit ratio is 25%, stock turnover ratio is 10 times, net working capital is going to be 5 lakhs, return on total assets pre-tax. Return on total assets is basically EBIT upon your total assets. That's going to be 15%. MPS is going to be 20 rupees per share. Total assets turnover ratio is 2.5 times. Opening stock is given as 650, 500. Fixed assets is 15 lakhs. Now there are 75,000 equity shares of rupees 10 each, so which means the equity share capital value is 7.5 lakhs, and 25,000 12% preference shares of rupees 10 each. So technically here there are 2.5 lakh rupees worth of preference share capital. Depreciation is given as 50,000 rupees, interest on debt is 9%, and future installments is given as 2 lakhs. So future installments is there. So obviously there's going to be, look at this service coverage, debt service coverage ratio they're asking. Fine. So tax rate applicable to the company is 25%. You are required to calculate number one, the quick ratio, then fixed asset turnover ratio, then debt service coverage ratio, EPS, and price earnings ratio. These are the ingredients given in the question, right? So first one, the quick ratio. Quick ratio means what? Your quick assets upon current liabilities, and quick assets is nothing but your current assets minus your inventories minus your prepaid expenses, right? In this question, prepaid expenses is not there, so because nothing has been mentioned relating to that, but they have given you a few hints to calculate your closing stock and all. And of course your current asset, current liabilities, you can calculate that using current ratio, working capital and all that. So based on this we need to go about. So first what we will do is we will first calculate all the missing figures, and then we will get into the final solution of solving all these five parts of the question, right? Pretty much straightforward. This is not a very tricky question and all that. There is only one thing in debt service ratio which they have slightly done it differently. That alone I will walk you through, but for that this question is pretty much straightforward. So now first one, the working note 1 is regarding calculation of current assets and current liabilities. So they have given current ratio is 3:1, which means what? Current asset upon current liabilities is going to be 3:1. Or in other words, we can say current assets is equal to 3 times current liabilities. So current assets can be expressed in terms of current liabilities. Yes. Now working capital is given in the question as 5 lakh rupees. I have the question with you. It's given as net working capital as 5 lakh. So current asset minus current liability is 5 lakh. Instead of current assets, we can now write it as 3CL. Correct. So 3CL minus CL is equal to 5 lakh. Or in other words, 2CL is equal to 5 lakh, or CL is equal to 5 lakh by 2, which is 2.5 lakhs. As simple as that. And now we know that current asset is equal to 3 times current liabilities. So current liabilities is 2.5 lakhs. Current assets is going to be 3 into 2.5 lakhs. That's going to be 7.5 lakhs. As simple as that. Guys, this is all elementary, which we have done a lot of such questions even in our marathon, even in our regular lectures, right? This is a very, very simple and a straightforward calculation. Next, calculation of average stock and closing stock. So now in this question, they have given the total assets. Can we calculate? Yes, the fixed asset figure is given in the question as 15 lakhs. Current asset we just calculated as 7.5 lakhs. If you add the two, the total assets is going to be 2.5 lakhs. The asset turnover ratio is given, right? So asset turnover ratio is 2.5 times. It's given in the question. Sales figure we don't have, but the total assets figure we just calculate 22.5 lakhs. So sales upon total assets is equal to 2.5. If you cross multiply, sales is equal to 2.5 into total assets. That is 2.5 into 22.5 lakhs. You get the sales value of 56.25 lakhs. Are you clear with this? Then GP margin, the GP ratio is given as 25%. If GP ratio is 25%, then the COGS is going to be 75% on sales, right? So COGS is 75% on sales. So COGS value is going to be 75% on 56.25 lakhs. You get 42 lakh 18,750. So now the stock turnover ratio formula, what is it? COGS divided by your average stock, right? So COGS upon average stock is 10 times, right? COGS figure we know, right? That is 42 lakh 18,750. So now can I say COGS divided by average stock is equal to 10 times, right? So average stock, can I say if I cross multiply, so COGS divided by 10, that is what they have done. So COGS divided by 10, they have arrived at the value of average stock, which is 4,21,825. Now in the question, opening stock value is given, right? Closing stock figure we need to find out. Are you clear with this? So now, because for us to calculate the quick assets, it's your current assets minus your inventories. So that is basically your total assets minus closing stock. Now in this case, we only have average stock. Can we calculate the closing stock? Yes. Average stock is nothing but opening plus closing by 2, right? Opening figure is given in the question, right? The balancing figure is going to be your closing stock. Very simple. So average stock is equal to opening, which is given, plus closing by 2. Or in other words, your closing stock is going to be what? So you can simply cross multiply and you can calculate. So this goes to the other side. It's going to be 421, 875 into 2 minus 650, 500. If you just do this normal cross multiplication and calculation, closing stock value is also arrived at 192, 250. Are you clear with this? Very, very simple, guys. With this, you can also arrive at this. Now they have calculated the cash EBIT. Why they have calculated the cash EBIT? Now, if you go to the formula for calculating debt service coverage ratio, right? Generally, it is your EBIT divided by interest plus installments. Some people who are very, very prudent, what they do is they arrive at the cash EBIT upon interest plus installments. This is one more way of doing at it. Are you clear with this? Right now in this question, they have gone for the cash EBIT formula. Now, cash EBIT, very simple. You arrive at the EBIT, right? Add back your depreciation. Sir, how do we know, sir? In this question, we should take cash EBIT. Depreciation is figure is given, no? Else, why will they give that? Are you clear with this? That's how you need to find out. Now, in this case, they have given the question that the return on total assets pre-tax is 15%, right? So 15% is equal to EBIT divided by total assets. Are you clear with this? EBIT, not cash EBIT, right? You have the total asset figure, you have the return on total assets figure. So now you cross multiply the two, you get your EBIT. So EBIT is 0.15 into 22.5 lakhs. You get 3,37,500 rupees. Are you clear with this? Now you add back depreciation to this, you get your cash EBIT. Are you clear with this? This is one figure that you can use for the purpose of calculating your debt service coverage ratio. Fine. The next one. Calculation of loaned funds to owned funds, that is debt and equity. In the question, they have given debt to equity is 1:3. They have given, no, right? Or in other words, which means what? Equity is 3 times your debt. Are you clear with this? So can I say equity is equal to 3 times debt? So how can you say, sir? Simple. Debt upon equity is equal to 3 by 1, right? Are you clear with this? Debt equity ratio is given as what? 3. Yes. Debt equity ratio is given as 1:3. I'm sorry, guys. They have given it as 1:3. So that's what I was wondering. Some issue is given. Yes, 1:3, right? Or in other words, if you cross multiply this, can we say equity is equal to 3 times debt? Are you clear with this? Very simple, right? Now, in this case, what happens if you use a normal equation, balance sheet side, total equity plus liability should be equal to your total assets. Equity plus liability is what? Equity plus debt plus current liabilities should be equal to your fixed asset plus current assets. Correct? Fixed asset figure given in the question. Current asset figure we calculated in the first step. Right? Current liability figure that also we calculated in the first step. Now, equity we don't know, debt we don't know. So what we can do is debt you retain as assets. Equity can be written in terms of debt. Read it. You clear with this? So now in this equation there is only one variable. Now you can easily find out. So 4 debt is equal to 4 debt plus 2.5 lakhs is equal to, so it's going to be fixed asset plus current assets, that is 15 plus 7.5, which is 22.5. So this 2.5 goes to the other side, minus 2.5. So overall 4 times debt is equal to 20 lakhs, or debt is equal to what? 20 by 4, it's going to be 5 lakh rupees, right? So equity component is going to be how much? 15 lakh rupees, because 3 times of debt. Are you clear with this? With this one is also over, and it's pretty much straightforward. Now the next one, now in this question they have asked us to calculate the EPS also. So for EPS, we need to prepare this income statement fully. EBIT, right? This figure we calculated quite some time back. So EBIT figure is 3,37,500. So you can put it here. Minus interest. Sir, how do we know the interest? Interest on debt given in the question, 9%. On how much debt value we just calculated? 5 lakhs. So 5 lakh into 9%, 45,000. If you reduce that, you get EBT minus 25% tax. You get EAT minus preference dividend. In the question itself, the figure is given. So they have given 25,000 preference shares of 10 each. So which means 2,50,000 rupees worth of preference shares into 12%. So this figure is given in the question. The calculation is given in the question itself, minus 30,000. You get earnings available for equity shareholders. EFE figure, you get it, right? If you divide this by the number of equity shares, which is again given in the question, 75,000, you get your EPS straight away. Are you clear with this? As simple as that. So now we have found out all the ingredients of this question. It's just a matter of plugging the figures. So quick ratio is what? Current asset minus closing stock upon current liabilities. So current asset figure is there. Closing stock we calculated. Current liability figure is there. So now we get the figure for quick ratio, which is 2.23:1. Fixed asset turnover ratio. Yes, we calculated the total sales of 56.25 lakhs divided by fixed assets. You just have to plug in the figures. You get 3.75 times. Debt service coverage ratio here. Cash EBIT divided by interest plus installment. Cash EBIT 387,500. Interest how much? We just calculated here. 45,000. Installment figure given in the question 2 lakh. Substitute, you get 1.58 times. So the logic for all these formulas, we've already seen it in our regular lectures. Here I'm quickly going through every single component in your RTP. We are not even missing a single thing. Are you clear with this? Next one. EPS, so earnings for equity shareholders. So 1,89,375 divided by the total number of equity shares of 75,000. You get an EPS of 2.53 rupees. Are you clear with this? And price earnings ratio, MPS upon EPS, right? Price upon earnings. This figure is given in the question, right? This figure we just calculated right now. If you divide the two, it's going to be 7.91 times. Are you clear with this? With this question is over. See how simple it is, provided you have the right approach to this particular solution. And with that, we are done with this particular question on ratio analysis. Now, let's move on to the next question. Now, this question number 5 is from the chapter Cost of Capital. So, let me quickly read out the question for you. The capital structure of Samyaktva Limited is as follows. So, 12% debentures, 3.5 lakhs, 14% preference shares, 4.5 lakhs, and equity shares with a face value of rupees 10 each, 8.5 lakhs. So in the books, the total capital employed is going to be 16.5 lakhs. So the capital structure is given. The breakup of debt, equity, and preference is given. Additional information. Rupees 100 per debentures redeemable at a premium of 6% with a flotation cost of 5% and 5 years of maturity. The current market price of the debenture is 115 rupees, right? So what you can do is you can use the shortcut formula. Nothing has been mentioned in the question. So what you can do is use the shortcut formula, find out the value of KD. Next, 100 per preference shares redeemable at a premium of 10%, issued at a discount of 2% with a flotation cost of 5% on the issue price. The current market price per preference shares is rupees 108. So this is also given. It has a maturity of 10 years. Now guys, very, very important. They have given it is issued at a discount of 2%. And they have also given the current market price of 108. A very unique sign, a very, very unique type of adjustment. This is something that is not given in the study material also. Now what you need to do, what they are trying to mean is, currently, if you go to the market, in the secondary market, if you want to buy the preference shares, it will be quoting at how much? 108 rupees. Now, because they are issuing directly to the public, they are saying they are planning to issue it at 2% discount as compared to what it is being quoted in the market. Here with this. So, in this case, the issue price will be 108 into 98%. So, 98% of 108, issue price will be what? 105.84. From that, you reduce the flotation cost, right? So on this, the flotation cost will be 0.05. So if you reduce the flotation cost of 5.292 rupees, the net amount is going to be your net proceeds that you need to consider for the purpose of calculating your KP. Are you clear with this? Very unique adjustment because they have given a discount and at the same time they have given the current market price. It means that discount is on the current market price. Clear? Generally, discount we apply it on the face value. If nothing has been mentioned, we assume that it's on the face value, but in this case, they have given a current market price as well as they have given a discount. It means in the market, it is quoting at 108. Obviously, why will the company not sell it at 108? But they are saying that, look, I'm giving a discount. So I'm motivating people not to buy it from the secondary market. Directly, I'm issuing now. You can buy it from me. Are you clear with this? This is the meaning of that. Then finally, an equity share has a flotation cost of 5 rupees with the market price per share currently quoted at 30 rupees. Samyaktva Limited has paid a last dividend of rupees 4. The company is expected to give an annual growth of 9% on dividends. And the company has a practice of paying all earnings in the form of dividends. So it's fully in terms of dividends, right? So how do you find this? Very simple. So K is equal to D1 by P0 plus G. Growth rate given in the question. P0, I think it's given in the question. P0 as in the net proceeds, 30 minus 5, 25 rupees. D1, last period dividend was 4 rupees. So 4 into 1.09. So you substitute all these figures, KE value is also given, right? Corporate tax is given in the question as 25%. Calculate the VAT using market weights. Guys, pretty much a straightforward question, except for this unique adjustment in preference shares. Everything else is going to be the same. Are you clear with this? Let's quickly run through the solution, and with that, we're done. Now, cost of debt. So what is going to be the formula? I into 1 minus T plus RV minus NP divided by N the whole by RV plus NP by 2. Very logical formula. We've seen all the logics in our lectures, in our regular lectures. Fine. So now what is going to be the redemption value? Look at the question. It is redeemable at a premium of 6%. So 100 plus 6%, 106 rupees. One figure is done. N is the term, it's given as 5 years, right? Tax rate is 25%. Now, net proceeds is going to be issue price minus flotation cost. Now, what is going to be my issue price? They have given in the question that okay, so the current market price of debentures is 115, right? So you can take that as the issue price. Now they've given that a flotation cost is 5%. Now, flotation cost, if nothing is mentioned in the question, if the question is silent, the 5% can be applied either on the face value or on the issue price. Very strictly speaking, I've told you the correct way of doing it is calculating on the issue price only, because on the issue value only, the flotation cost like your underwriter's commission and all will be incurred. But anyways, institute is taking different stands in different question. In this case, the question is silent and institute has taken a stand that this 5% should be calculated on issue price. Sir, can we calculate it on face value? If you want, you do it, but write a note. Are you clear with this? Answer will change. Absolutely, it will change. Right. So now 115 minus 5% on 115. If you do that, net proceeds is going to be 109.25. Now you have the redemption value, you have the net proceeds, you have N, you have T, and you have I also. So interest is how much? 12% on 100. That's going to be 12 rupees, right? So now per debenture, I'm saying you substitute all these things in the question. I mean, in the formula, you arrive at a KD of 7.76%. Are you clear with this? Pretty much simple and straightforward. The next one, calculating the cost of preference shares. So what is the formula for preference shares? Exactly same as your KD calculation, except for one difference. Here, the dividend is not. It's not a tax deductible expense. So instead of I into 1 minus T, it's directly your preference dividend, right? So now preference dividend, how much is that? Okay, so let's quickly go through every single component. Redemption value. Look at what is given in the question. They have said it's redeemable at a premium of 10%. So 100 plus 10% on 100, it's going to be 110. The number of years is going to be 10 years. Right, the net proceeds is going to be issue price minus flotation cost. This is where I said very, very important. What's your issue price? Currently, if you go to the market, it's being sold at 108 rupees. Now, the company plans to give it at a discount of 2% as compared to the market price. This is not given, but this is understandable, right? So, 2% on 108. So, technically speaking, the issue price is going to be 98% or 0.98 into 108. So, 108 into 0.98, you get how much? 105.84. Are you clear with this? Now, out of this, you need to reduce a further 5% for flotation cost. So 105.84 into 0.95. Ideally speaking, after adjusting for your flotation cost, you get 100.548. They have rounded it off to 100.55. This is going to be your net proceeds. Are you clear with this? An excellent calculation, guys. Very, very important calculation. Watch out. This can either come in your Jan 25 or in your May 25 attempt. Be very careful about this, right? So now the KP calculation is going to be your dividend 14% preference shares. No, it's going to be 14 rupees into plus RV minus NP divided by N divided by RV plus NP by 2. So you just substitute the figures, you get a KP of 14.19%. And finally, you've got the cost of equity. Since the growth rate is given in the question, so KE needs to be calculated using the Gordon's formula. So the formula is going to be D1 by P0 plus D. D1. So how much is D1? Currently, they have given the last paid dividend was 4 rupees. So D1 is going to be 4 into 1.09. Correct. So 1 plus G. G is going to be 9%. Right. P0. How much is that? It's going to be 30 minus 5. That's going to be 25 rupees. And G is going to be how much? G is given as 9%. Right. So you substitute this. So D1 is equal to 4 plus 9% of 4. That's nothing but, so 4 into 1.09, 4 into 1.09, you get how much? 4.36 divided by 25. That's going to be your P0 plus 9%. So 4.36 divided by 25, that's 17.44%. 17.44% plus 9% gives you 26.44%. Are you clear with this? So we calculated KD, KP and KE. So now what you need to do, you need to calculate the WACC using market capital weights. So the respective cost of capitals, you can just fill it in this particular column. Now you need to arrive at the weights. So weights using market value weights they have given. So totally how many debentures are there? The question they have given. The value of total debentures is 3,50,000. Right, and every debenture has a par value, face value of 100. So totally there are 35,000 debentures, and for every debenture the current market value is how much? 115. You multiply the two, you get the value of debentures. Similarly, preference shares, 4,50,000 divided by 100. So 4,500 preference shares are there into 108. That is the current market price. Sir, 108 minus 2% discount? No, that is issue price calculation. Here we are calculating the market weights, market value. Clear with this, right? And finally, equity shares. So how much is that going to be? So you have a total of 8,50,000 equity shares, 8,50,000 rupees worth of equity share capital. So each share has a face value of 10 rupees. So divided by 10, 85,000 shares, and every share has a current market price. It's quoted at 30 rupees. So now flotation cost should not be adjusted while arriving at the market value. That should be adjusted only for the purpose of calculating your net proceeds. Are you clear with this? So you multiply this, you get the respective amount of equity, respective market value of debentures, preference, and equity. With that, you can arrive at the market value weights, right? Here you anyways have the cost. You marry these two figures, that is your weight into the respective cost, you arrive at an overall cost of capital of 22.52%. Are you clear with this? As simple as that. That's about it. In this question, the only unique adjustment was with respect to your KP calculation. In KP also, not everything was new. In net proceeds, for you to calculate net proceeds, you need to arrive at the issue price minus the flotation cost. And for you to calculate at the issue price, they had given a discount rate also. They had also given a current market price, which means you should know that the discount needs to be applied on the market price. That is the only new value addition in this particular question, right? So with that, we have finished this particular question on cost of capital. Now let's get started with the next numerical problem, which is from the chapter capital structure decision, right? So Retail Limited is in the expansion stage and it provides you with the following information. So EBIT is 5 lakhs less interest on debentures, the rate of 10%. The interest amount comes out to 1 lakh rupees. So that gives you EBT minus income tax rate of 30%. That gives you EAT, right? It looks like there's no preference and all. So this automatically becomes your earnings available for equity shareholders. And the current number of equity shares, the rate of 10 each, the number of shares is going to be 50,000 shares. So the EPS currently is 5.6 rupees per share. And the price earnings ratio is given as 10 times, which means what? Your NPS, your market price per share, becomes rupees 56, right? So your EPS into your PE ratio gives you your total market price. Your price earning ratio 10 times means what? The market price is 10 times your EPS, right? So basically you multiply the two, you get your MPS. Now, the company has a reserves and surplus of rupees 10 lakhs and required further 5 lakh for modernization. So they require an additional 5 lakh rupees. Extra funding is required. The return on capital employed is constant, right? So obviously we all know the return on capital employed or your return on investment is going to be the constant. Operating profit ratio is going to be constant. We know that. So the debt ratio, that is debt equity ratio, if it is lesser than 2, this will raise the PE ratio to 12 times. This is what they have given. The interest rate on additional debt is going to be 12% and you are required to ascertain the probable price per share. You need to calculate the market price per share in each of the two scenarios. Scenario number 1, if this entire additional 5 lakh rupees is raised through the debt mode. And scenario number 2, if the entire 5 lakh rupees is raised through the equity mode at the ruling price. Ruling market price means what? At rupees 56, current market price, right? So if this is the case, what will be the new market price per share? Are you clear with this? This is what they have asked for in the question. Clear with this, guys? Now, there is one small issue. There is some small error in the solution given. I will let you know what it is and not. In fact, the framing of the question itself has one lacuna. Sir, what it is, I will let you know. Now, first, what have they given? Now, equity component, debt component, right? Existing, what is there? Existing, what is there? Now, in the question, okay, I will just go to the solution part and explain. This will be easier for you to follow. Now look at this. Currently what they have given, please have the question with you. They have given in the question that at present, what is the total number of, what is the total equity share capital value? 50,000 shares, number of shares is given, each 10 rupees, 50,000 into 10. The total value of equity share capital is how much? 5 lakh rupees, right? Then in the question they have given, the total interest paid is 1 lakh rupees, correct? They have given it in the question. Now the interest rate on debentures is 10%, right? So basically we know debentures amount capital into 10% is going to be interest, right? Or in other words, debenture capital is equal to interest divided by 10%. So now how much is the total interest they have paid? 1 lakh rupees. 1 lakh divided by 10%. If 1 lakh is the interest component, how much would have been your total debentures value? 1 lakh divided by 10%, that's going to be 10 lakh rupees, right? This is also fair enough, a straightforward computation. And further, it is given in the question that the currently company has a reserves of 10 lakh rupees. Are you clear with this? So basically 5 lakh rupees is the equity share capital, 10 lakh rupees is your debentures, and 10 lakh rupees is your reserves and surplus. Currently, the company has a total capital employed of how much? 25 lakh rupees. Are you clear with this? Right. So now can I say debt equity, right? So now existing, what is there? Existing, what is there? The total equity component, how much is it? 5 lakh plus the reserves and surplus of 10 lakh rupees. So can I say currently the company has 15 lakh rupees worth of equity component, and currently the company has 10 lakh rupees worth of debt component. Correct, guys? Yes, fine. So basically the total capital employed, how much is that going to be? 25 lakhs currently. Now look at this. Look at this. Alternative one. Alternative one. What is the alternative one? They require 5 lakh rupees more, and this entire amount is raised through the debt mode. If they are raising it through the debt mode, what will happen? This extra 5 lakhs. Currently, I have a debt of 10 lakhs. Plus, additionally, I will be having 5 lakh. So the total debt value will be how much? 15 lakh. Equity value, it remains to be the same, right? Because I'm not raising anything through the equity mode. So the total capital employed is going to be how much? 30 lakh. Correct, guys? Right. Or if you're going for alternative 2, what they are saying, now the extra 5 lakh, I will not disturb my debt fully by issuing new equity shares. So what happens here? Now in the new case, what happens is debt continues to be 10 lakhs, but equity component will become 15 plus 5 lakhs. It will become how much? 20 lakh rupees. The total value of debt component, the total capital employed is going to be 30 lakhs. Are you clear with this? Now in the question, what they have said, now they have said, if the company has a PE ratio, if the company has a debt equity ratio of less than 2, right? Less than 2 times, the PE ratio will become 12. This is what they have given, right? So now currently at present, what is the debt equity ratio? Let us try to calculate. Currently, what is the debt equity ratio? Debt upon equity, 10 divided by 15. How much is that? It is 0.6666. Right. Alternative 1, what will be the debt equity ratio? Debt upon equity, 15 upon 15, it will be equal to 1 time. Right. Alternative 2, what will be the debt equity ratio? 10 upon 20, it is going to be 0.5 times. Correct, guys? Now, first of all, currently itself the debt equity ratio is less than 2 times only. Right. Currently itself, at present, the debt equity ratio is less than 2 times only, but still they have given a price earning ratio of 10. Okay, fine. Forget that. Leave it. Now, in this, what they have done, whether you go for alternative 1 or you go for alternative 2, in both the alternatives, what is happening to your debt equity ratio? It is less than 2. So what will happen? Whether you are an alternative 1 or an alternative 2, your P ratio will be now 12 times instead of 10 times. Correct? But see what they have done. Only for plan 1, that is only for alternative 1, they have taken the P ratio as 12. In alternative 2, they are retaining it as 10 times. Ideally speaking, this is a mistake. This should also be 12 times. This is something that I wanted to point out to you right at the beginning, even before we get into the solution. Reason is, all other calculations are pretty much straightforward. This is the only area where I felt they have made a mistake. It's an error in the RTP, which I think they will be coming up with a corrigendum. But as of now, you please understand, debt equity ratio in both the alternatives is going to be less than 2 times only. So under both the alternatives, the P ratio will increase to 12 times. In fact, at present itself, it is less than 2 times only. Then how at present it will be, the P ratio can be 10. Ideally speaking, now itself it should have been 12. But that is a lacuna in the framing of the question. Nothing to worry about that. But at least this part they should have kept it as 12. But I don't know how it got missed out. This is something that I want to tell you. So now, guys, you need to calculate the NPS, the market price per share, under both the alternatives. What will you do? You prepare the entire income statement, your EBIT minus interest, EBT minus tax, EAT, which is ideally your earnings for equity shareholders, divided by the total number of equity shares under both the alternatives. You get the MPS, multiplied with the PE ratio, you get the EPS, multiplied with the PE ratio, you get the MPS. As simple as that. This is the approach to the solution. Now, the only thing here is, in case you are raising this additional 5 lakhs through the debentures mode, the interest amount needs to be separately calculated. In case you are raising the entire 5 lakh through the equity channel, the number of equity shares will now increase. That will affect your denominator and hence your and hence your EPS. This alone will be different, but for that everything else is going to be the same. So now, before we do that, first we need to calculate the return on capital employed, right? Because at present, whatever EBIT they have given in the question, 5 lakh rupees, that EBIT is for what? That EBIT is for the present capital employed of 25 lakhs. If I increase the total capital employed by 5 lakhs, on that extra 5 lakhs, also some incremental profit will be there. So how do we compute? Using your return on capital employed or ROI formula, right? So at present, we calculated the total capital employed is how much? 25 lakhs. The current EBIT given in the question is 5 lakh. Means what? On an average, the company earns 20% as operating profit. If you infuse 100 rupees, 20 rupees will be your EBIT. Are you clear with this? This is the meaning of that. So for every 100 rupees infused into the business, irrespective of where it is coming from, debt or equity, I'm not bothered. Every 100 rupees infused, 20 rupees will be your earnings before interest and tax, or in other words, that's going to be your operating profit, right? Why do we need that? Because currently the company is having 25 lakh of capital employed. Now they are going to infuse 5 lakh. So on 30 lakhs, so now how much is going to be my EBIT? So 30 lakhs means 30 lakhs into 0.2, 6 lakh rupees is going to be my new EBIT, whether you're going for plan 1 or you're going for plan 2. So EBIT is going to be what? 20% on the new capital. That's going to be 20% of 30 lakhs, 6 lakhs and 6 lakhs in both the cases. This is why I said your EBIT will not be different based on your capital structure. EBIT is nothing but your operating profit, right? So plan 1 is what? Entire amount raised from debt. Plan 2 is what? Entire amount from equity component, right? Now from this, less interest on old debentures. How much is that? 10 lakh into 10%, 1 lakh and 1 lakh, right? Now in plan 1 alone, what happens? You will be raising the entire amount from the debt mode, and for this 5 lakh rupees extra, so how much is going to be the interest? It's given in the question as 12%. So 12% on 5 lakh, 60,000 rupees. This will not be there in your plan 2 because it's coming entirely from your equity mode, right? So your EBT is going to be your EBIT minus both the interest, right? Less tax, you get your EAT, right? Divided by number of equity shares. Number of equity shares in plan 1 remains to be 50,000. Why? Because you know number of equity shares will not increase in plan 1 because the entire amount of 5 lakh rupees is getting funded through the debt mode. Whereas in your plan 2, your number of equity shares will increase. By how much? That is the separate working note that we have. Now they have given in the question, we need to raise 5 lakh rupees at the current market prices. So 5 lakh divided by 56 rupees. So that gives you a total number of 5928.57. You cannot issue fractional shares. Round it off to the next number always. That's going to be 5929 shares, right? So, or in other words, after the fresh issue of shares, what will be the total number of shares? 50,000 plus 8,929 shares. It's going to be 58,929 shares. So you just go up and you can update it here. So you divide the current earnings after tax. This is also your EFE. EFE divided by number of shares, you get the EPS under both the alternatives, right? So now, once you do that, what you need to do, you need to arrive at the PE ratio. P ratio at present is 10, but they have mentioned in the question that if your debt equity ratio is less than 2 times, then your PE will increase to 12. So in both the cases, it is going to be 12. This is what I mentioned. There is an error in the question because under both the scenarios, your debt equity ratio is going to be less than 2 only. It's going to be less than 2, and hence it's going to be your PE ratio will increase to 12 times. Are you clear with this? So now you multiply 6.16 into 12. So under alternative 1, your MPS is going to be 73.92. Alternative 2 is going to be 5.94 into 12. That's going to be how much? This is wrong. It is going to be rupees 71.28 rupees is going to be the new MPS. Are you clear with this? As simple as that. It's pretty much a straightforward question. The normal calculations, whatever we've seen, it's a very regular question only. The only difference is there's some issue or error with respect to calculating the P ratio for alternative 2, right? But for that, every other aspect is going to be the same that we've seen generally in these type of questions, right? So with that, we are done with this particular question on your capital structure decisions. Now let's move on to the next question, which is from the chapter leverages. So now question number 7. Now this is a direct question, no catches, nothing. It's a very simple question. Let me quickly read out the question for you. From the following financial data of company X and Y, prepare the income statements, calculate the margin of safety for both the companies, and calculate the percentage change in EPS for both the companies if the percentage change in sales is 25%. So EPS and sales, topmost and bottommost figure they are comparing. Ideally speaking, this needs to be done using combined leverage concept only, right? So they have given X and Y. So variable cost, company X is given in figure, company Y is given as a percentage of sale. Fixed for cost for company X, it's given. Company Y, they have not given it. Interest for both the figure of both the companies, it's given. Financial leverage 4:1 for company X, company Y not given. Operating leverage, company X they have not given. Company Y it's 5.5:1. The income tax rate 30% for both the companies. Sales figure for company X they haven't given it. Company Y they have given it as 1,45,000 rupees. Right, that's about this question. So using this first, let's prepare the income statement. And then margin of safety, very simple. 1 divided by operating leverage is going to be your margin of safety, which is expressed as a percentage of sales, right? This is the formula, you can directly do it. And finally, they have arrived, they've asked you for the percentage of change in EPS, that we can automatically do it by using the combined leverage formula and all. So for that, the first basic thing that we need to do is to calculate, prepare the income statement, right? What is the format for income statement? Sales minus variable cost gives you contribution, minus fixed cost gives you EBIT, minus interest gives you EBT, minus tax gives you EAT, right? No preference here, so it's EAT, right? So that's about it. I think we can stop it there because the number of equity shares and all that is not given in the question, so we can stop at EAT. So now, how do we go about with this? So first, we need to prepare the income statement. So let's do it for company X first. Pretty much simple. So they have given financial leverage. It's 4:1. Now financial leverage is what? EBIT upon EBT. EBT is nothing but EBIT minus interest. Interest figure, this is also given in the question as 12,000 rupees, right? So financial leverage is 4 times. So we can equate this. 4 is equal to EBIT upon EBIT minus interest. So there is only one variable that we need to find out. So you cross multiply, you can arrive at the EBIT figure. Guys, this is a very straightforward calculation which we do in almost every single sum and leverage chapter. You can arrive at EBIT, and EBIT is 16,000. So EBT is going to be 16,000 minus 12,000. 12,000 is interest given in the question. It's going to be 4,000 rupees, right? So now once we have calculated this, so you can put it here. EBIT is going to be 16,000. Now you can plug the figures given in the question. Sales figure, it wasn't given, right? Variable cost, this figure was given in the question, right? So less sales minus variable cost gives you contribution. Contribution minus fixed cost. The fixed cost figure is also given in the question, right? Gives you EBIT. EBIT we just found out right now. This figure we found out, right? Minus interest of 12,000. This is given in the question. So this gives you EBT, right? Minus tax rate 30% on this. You get your EAT. Now going forward, as of now, we have this EBIT figure, right? From this fixed cost of 35,000 is given. So EBIT plus fixed cost gives you a contribution of 51,000 rupees, right? Now this variable cost figure is also given. Sales minus variable cost is contribution, or contribution plus variable cost. This gives you the sales figure. It's all reverse working. So this way we have literally calculated the entire income statement for company X, right? This is exactly what they have given. Contribution is EBIT plus fixed cost, and sales is contribution plus variable cost. It's all reverse working, guys. Simple. Next, for company Y. For company Y, how can you calculate? They have given the operating leverage, and they have given you what else have they given you? Yes, it is an operating leverage. That is the thing they are given. And one more thing, they have given that sales figure is 1,45,000. Sales is 1,45,000. Variable cost ratio is 65%, which means what? PV ratio is 35% on sales, right? So with this, I can arrive at the contribution. How much is contribution? Contribution is 1,45,000 into 35% on that, right? So 145,000 into 0.35, you get 50,000, 750. Operating leverage is your contribution upon EBIT, right? So you get what EBIT figure it is arrived at. So 5 is equal to 5750 upon EBIT. So EBIT cross multiply 5750 divided by 5. You get 10,150 rupees. Are you clear with this? So you can just go up, and remaining you can just do it. So 10,150 is your EBIT, which we found now. Sales figure given in the question. Variable cost 65% on sales. This also is given in the question. If you subtract the two, you can arrive at this figure. Minus fixed cost. Fixed cost, how do we calculate? We don't know this figure, but contribution is there. EBIT is there. So what you can do, this is a balancing figure. That is 50,750 minus 10,150. The balancing figure, you get it as 40,600, right? So you get your EBIT minus interest 6,000 rupees. I think this is given in the question. So finally, what you get is your EBT, right? From that, you subtract the tax 30% on that. You get your EAT. Guys, this is a very routine and a normal sum which can be solved very easily. Margin of safety, yes, very simple. It's 1 upon operating leverage. So for company X, So what's going to be operating leverage? Operating leverage formula is going to be what? Contribution divided by your EBIT, right? Contribution upon EBIT. So company X, it's going to be how much? 51 upon 16. Look at this. 51 upon 16. Company Y, it's going to be 5750 upon 10,150. Right? So you just do the calculation, just normal substitution of formula. So company X, the operating leverage is 3.1578, right? So 1 upon 3.1875, you get how much? 31.37% is the margin of safety for company X. Company Y is going to be 5:1. Again, it's given in the question, so you need not calculate ideally. So 5:1 is the operating leverage. So 1 by 5 is going to be 20%. Are you clear with this? With this, the second part of the question is also over. Third part of the question, calculate the percentage change in EPS if the percentage change in sales is going to be 20%. So now combined leverage for company X, so how much is combined leverage? Contribution upon EBT, we have both the figures, 51,000 upon 4,000, it's 12.75, right? And the other formula for combined leverage is what? Percentage change in EPS divided by percentage change in sales. So 12.75% is equal to percentage change in EPS, that's something that we need to calculate, divided by percentage change in sale, they have given it as 25%. So if you cross multiply the two, you get how much? 12.75 into 25%. So the percentage change in EPS of the company is going to be how much? 318.75%. Are you clear with this? Guys, this is a normal calculation, nothing great in this sum. That's why I'm quickly walking you through this. Similarly, for company Y, what's going to be the combined leverage? So combined leverage is going to be, once again, the same formula that you need to follow. Contribution upon EBT, these two figures are there. You get 12.23 times, right? And the other formula for combined leverage is going to be what? Percentage change in EPS upon percentage change in sales. So 12.23 is equal to percentage change in EPS that we now need to calculate divided by 25%. Company Y is going to be 305.75%. As simple as that. So with that, we've completed this question. It's a very, very normal question. So the degree of complexity is not there. It's a pretty much straightforward question which you can just go ahead and solve. Right? With that, we have finished this particular question number 7 on leverages. Now, let's move on to the next question. This question is from the chapter Dividend Decisions. Right? So now, let me just quickly read out the question for you. The following information is supplied to you. The total earnings is 4,50,000. Number of equity shares of 100 each, 25,000 shares. Retention ratio, it's 40%, and the market price per share is going to be 198. Applying Walter's model, number 1, analyze whether the company is following an optimal dividend policy. Number 2, compute the price earnings ratio at which the dividend policy will have no effect on the value of the share. Also, compute the MPS, the market price, at such PE ratio. And number 3, will your decision change if the PE ratio is 4.5 times? Analyze. Now, first one, guys, what does Walter say? Walter says there are 2 ingredients that you need to take into account to compare and find out whether the company is following an optimal dividend policy. What are the 2 ingredients? R and KE. And what he says is R stands for return on investment or return on equity, as the case may be, right, based on the data given in the question. In this case, we can take it as return on equity, or we can assume that equity is the only source of investment. It's an unlevered entity. If that is the case, return on equity is equal to return on investment. Very clear. Fine, there's only one source of investment means the return to equity shareholders is ideally the return on investment, because the entire investment is only from equity. Fine. What Walter says is, if R is greater than K, then what you need to do, do not distribute anything, right? Do not distribute anything. Dividend payout ratio should be 0 to maximize the value of the share. Whereas if R is less than K, then you distribute everything. Logic and all we have seen already in our lectures, right? Now, in this question, the first thing that you need to do is calculate R, calculate K, and once you have done this, more or less, you will be able to figure out the entire solution. Now, how much is R? R is basically your return on your capital employed or return on investment. In this case, the other sources of finance data is not given, which means you can assume that the only source of finance is going to be equity. So how much is this? Total earnings 4,50,000 divided by the total investment or equity shares. It's only from equity shares. 25,000 into 100. So it's going to be 4,50,000 divided by 25 lakhs. Clear with this? Look, this is what they have also done. Return on investment is 4,50,000 total earnings divided by the total equity share capital, 25,000 into 100, it's going to be 25 lakhs. Return on investment is 18%. And as per Walter, what he says, ROI, that is R is greater than KE, then the firm should retain everything, distribute nothing to maximize the share price. On the contrary, if ROI is less than KE, the firm should distribute everything and retain nothing. Are you clear with this? Right? In this case, what is R? R is equal to 18%. Right? Now, KE can we calculate? Now, remember there's one formula. KE is equal to 1 divided by PE ratio. Right? So, PE ratio is what? MPS, market price. Price upon earnings. Price earnings ratio. Price divided by earnings. Now, price is how much? So, that's going to be 198. How much is the EPS per share? Now they have given in the question 4,50,000 is the total earnings. Number of equity shares is 25,000. 450,000 divided by 25,000. Current EPS is going to be how much? 18 rupees. How you got this? 4,50,000 divided by 25,000 shares. Are you clear with this? If you do this, you get your current PE ratio. 1 divided by PE ratio, you get your KE as how much? 9.091%. 9% approximately you keep. Now, what is the current return the company is earning? 18%, right? What is the KE? It's going to be 9%. Now you tell me, ideally speaking, what the company should have done, ROI is greater than KE, so the company should have retained everything and it shouldn't have distributed anything, correct? Since ROI is greater than KE, optimal dividend policy should be is to retain everything and distribute nothing. However, what is the company doing? They are retaining 40% and distributing 60%. Ideally speaking, they should have retained 100%. Are you clear with this? So, which means what you can say, the company is not following the optimal dividend policy as per Walter. This is what you can. Next, compute the PE ratio at which the dividend policy will not have any effect on the value of the firm. Means what? What does Walter say? If R is greater than KE, retain everything. Only if you do that, you will get the maximum share price. The share price will be maximum. If R is less than KE, you distribute everything. Do not retain anything. Only then the share price will be at its maximum. Whereas, if R is exactly equal to KE, then the dividend policy has no relevance. Whatever you distribute, irrespective of whatever you distribute or retain, it will not have any impact on the share price. This is what Walter says, the derivation of that and all we have seen in our classes. Now look at this. Compute the PE ratio at which the dividend policy will have no effect on the firm. Means what? Means what? They are talking about a situation where R is equal to KE. Are you clear with this? This is what they have mentioned. You need to understand. When R is equal to KE, the dividend policy of the company will have no effect on the value of shares as per Walter model. So in this case, what should have happened? So your KE should be equal to how much? 18%, correct? Only if your KE is equal to 18%, right? In that case only this scenario will happen. Are you clear with this? If your KE is 18%, so what will happen to your PE ratio? We know that KE is equal to 1 by PE ratio, right? So or cross multiply, PE ratio is equal to 1 upon KE. So 1 divided by 0.18, PE ratio becomes how much? 5.56 times. They have asked you calculate the MPS at such PE ratio. So how much is that? EPS we know is 18 rupees. We just calculated above, no? So EPS we just calculated above. It's 18 rupees, right? 18 into 5.56. So in this scenario, my market price will be 100.08. It will never change. Whether you keep your dividend payout ratio as 20%, 40%, or you distribute everything or you distribute nothing, no change will be happening on the share price. The share price will be at 100.08 rupees provided your R is equal to KE if you are following Walter's model. This is what Mr. Walter says. Next, finally, will your decision change if the PE ratio is 4.5? If the PE ratio is 4.5, what happens to your KE? 1 upon 4.5 is going to be 22.2%, right? So R is equal to how much? 18%. KE is equal to how much? 22.2%. Now what happens? This is completely the opposite of the first scenario, right? KE is greater than R, or in other words, the company is earning some return that is way lesser than the KE. What should the company do? You don't have any funds with you. Distribute everything to the equity shareholders. Since R is greater than KE, optimal dividend policy should be to distribute everything and retain nothing, as the value of share would be maximum at that point, thereby maximizing the wealth of the shareholders. Are you clear with this? This is a very logical understanding of your Walter's model. This is something that they have coined as a numerical problem and they have asked. Are you clear with this? With that, we have completed this particular question number 8 on dividend decision. Now let's move on to the next question. This question is from the chapter investment decisions, capital budgeting, right? Once again, not much of tricky calculations involved here, but there's one short-term capital loss, the tax saving on short-term capital loss. That is one thing that is not unique actually, but that is one thing that generally in many sums they will say ignore capital gains or capital loss. But in this sum, they've asked you to consider that and compute as well as the only extra addition. But for that, this sum once again is going to be pretty much a straightforward question. Now, let me just quickly read the question for you. A company is considering the proposal to take up a new project which requires an investment of rupees 850 lakhs in plant and machinery and 150 lakhs in working capital. Very, very important. Now, working capital will be an initial outflow because you need to bring that money. And at the end of the project, it gets released. It becomes an inflow at the end of the project. Are you clear with this? Initially, it's an outflow, and at the end of the project, it's going to be an inflow. Are you clear with this? This is something that I've always been telling you. Watch out for this. The project is expected to yield the following cash flows before tax and depreciation over the next 5 years. They have given. Now, guys, I somehow feel this working capital adjustment in your capital budgeting sum somewhere I feel is going to come in your Jan 25 or May 25 attempt for sure, right? Because it needs to be treated as an inflow initially, and it needs to be treated as an outflow initially and an inflow at the end of the life. Please have this in your mind. Now, what have they given? The cash flows before interest and depreciation, they have given each of the years, the figures are given. The desired rate of return for the project is 14%. Basically, what this is going to be your discount rate, right? And the assets must be depreciated at the rate of 20% on WDV basis. Asset should be depreciated on 20% WDV, right? So you need to do that also. The scrap value at the end of the fifth year, 5-year period, may be taken as 140 lakhs. The income tax applicable to the company is 20%, and this is the only asset in the entire block, and hence the capital gains is taxed at 15% or loss as well. Means what? 15% is your capital gains tax. If you're having a loss, which means what? The tax saved on this capital loss is going to be applied at the rate of 15%. This is what they have given. You're required to calculate the NPV of the project and advise the management to take appropriate decisions. Fine. Also calculated the IRR and the desirability factor. Desirability factor is nothing but your profitability index. Present value of cash inflows upon present value of cash outflows. Perfect. IRR and the present value of 1 rupee at different rates of interest are given as follows. They have given you the table 14, 16 and 20 and all. 14% is basically your discount rate, right? For that they have given. 16 and 20, why have they given? So these are the two trials that you need to use for the purpose of calculating your IRR. Very simple, guys. They have literally given everything, fairly a small question, and do not make mistake in calculating your WDV values and all, right? I will just quickly walk you through the solution. Very, very simple, guys, but make sure you're not making some silly mistakes, right, with respect to calculation. Now, first, part A of the question deals with calculating the NPV. Now, first, calculation the present value of cash outflow. How much is the outflow today that I need to bring in? 850 lakhs of initial investment plus 150 lakhs of working capital. That comes out to 1,000 lakh rupees of the project value. That's going to be my outflow, right? And calculating the present value of cash inflows. In the question, they have given the net profit or cash flows before depreciation and tax. These figures are all given in the question, right? 290, 320, 360, 390 and 270, right? From this, I need to subtract depreciation. Now, depreciation, is that figure given in the question? No, it's not given in the question. It's on WDV basis. You need to calculate. How do you do? 850 into 0.2. How much is that? 170 lakhs for the first year, right? Now on the WDV, that is 850 minus 170 on 680 rupees. Once again, you calculate 20%. That's going to be 136. Are you clear with this? That's going to be the year 2's depreciation. Then on the WDV, once again, you calculate 20% and you go on like that. Year wise, you can arrive at the depreciation figures. Are you clear with this? You guys know how to calculate WDV, right? In fact, you've done complicated WDV calculations in your accounts itself, right? That's what it is. So now you get what? Profit before tax, right? Now, net profit before tax minus tax at the rate of, the rate is given in the question as 20%. Right, so at the rate of 20%, you get your net profit after tax. Now, what you do? Immediately add back your depreciation, right? You get your cash flows after tax. So, why are we subtracting and adding depreciation? We subtracted depreciation on the net figure. We computed the tax and we added it back. Basically, the depreciation has a tax impact. That's the reason why we are adding it before tax, and we are subtracting it before tax and adding it back once the tax figure is computed. Right. Now, what happens? Apart from this, are there any other cash flows? Yes. First one, the working capital gets released at the end of the project. So this is going to be an inflow for year 5. Then they have mentioned in the question that uh, the at the end of the 5-year period, the scrap value of the fixed asset is going to be 140 lakhs. That's going to be an inflow for me, 140 lakhs. Are you clear with this? And there is a tax shield also that they have computed separately, right? So now what they have done, so based on all these things, the PV factors given in the question, these figures are also given in the question, right? So they have just multiplied the CFAT with the present value factors. They have arrived at the present value of cash inflows. So these 4 figures directly they have arrived. With respect to the last year figure, it's going to be 229.93 plus 150 plus 140. This is the total figure of 519.93 into 0.52. You get this 270.3636. This figure you have arrived. So basically they have added these figures because these 3 are cash inflows arising at the end of year 5, right? And multiply that with the present value factors, you get 270.36. Are you clear with this? Fine. So now the total present value of cash inflows is going to be 112.40. You add up all these things, you get this. But wait, you also need to consider the tax impact. There is going to be a short-term capital loss and all. The present value of tax savings on short-term capital loss. Now, WDV at the end of 5th year is 278.53. How do you get this? If you prepare that WDV schedule, you will know. Or very simply, sum total of all the depreciation, how much is it? 170 plus 136 plus 108.8, again 108.8 plus 87.04 plus 69.63. So the sum total of all the depreciation is 571.47, right? That you subtract from the initial investment of 850 lakhs, you get how much? You get this figure of 278.53. Are you clear with this? Or you can say, so 850 lakhs minus 20% depreciation, WDV once again on the 20% year 2 depreciation, WDV once again on the 20%, like that you do it. At the end of year 5, this is the WDV value, the closing WDV. Now they have mentioned in the question that they are able to sell this for how much? 140 lakhs. So basically, as per the books, the cost, the written down value cost is how much? 278.53, which they were able to sell it only at 140. And now, since there is only one asset in the block, it ceases to exist. So now what happens? I've taught you that capital gains will attract, right? So basically what will happen in this case, the difference between this two, 278.53 minus 140, you get 138.53. This is going to be a short-term capital loss on that tax savings of 0.15 percentage. So 15 percentage, how much is it? 20.7795, rounded off to 20.78. 20.78 rupees is going to be the tax saving that you will arrive at the end of year 5. See, on the top, they have not considered the tax saving. They have only considered the scrap value, right? Over and above the scrap value, you get another tax saving of 20.78 rupees, right? So that has not been considered. Now you consider it. 20.78 into 0.52. 0.52 is going to be the present value factor for 14% at the end of 5 years. So you multiply that, you get how much? 10.81 lakhs. So now NPV is going to be what? Present value of cash inflows 1124.40. This figure you've already got here, right? This is the sum total of all this. Sum total of all this 1124.40, right? Plus right now we've got this 20.78 rupees, sorry, into 0.52, you get 10.81. This is the tax saving, right? Minus the initial outflow of 1000. So you have an NPV of 135.20 lakhs. So now it's a positive NPV. Since the NPV of the project is positive, the company can go ahead with this. Are you clear with this? Pretty much straightforward, guys. So there's only one thing that is slightly different from the questions that institute generally ask, that is with respect to computing the tax impact on your short-term capital loss. In fact, we've done one question in our regular lectures as well regarding this. Now, the next one is regarding calculating IRR. Fine. So now you know that at 14% discount rate, what happens? It's giving you a positive NPV. So which means you need to try increasing the rate. Only then you can you can make your NPV equal to 0. Right? So at IRR is that discounting rate where NPV is equal to 0. You all know that, right? And at 14%, the NPV is going to be positive. So you need to use some trial and error method to make your NPV equal to 0. So at 16% discount rate, if you take R is equal to 16%, the first trial. So you have all your CFAT plus working capital release plus scrap. This happens only at the end of year 5, right? So if you use, I think this is 16%. This is not 14. This is 16%. They have the figures, they have properly picked it, but it's not 14%. It's 16%. So what happens? The present value of cash inflows. So this is what it is. If you add it up, you get 1067.31, right? plus there is a present value of tax saving on short-term capital loss. So 20.78 is a tax saving on short-term capital loss into 0.48. 0.48 is nothing but your present value annuity, present value factor for 16% at the end of 5th year. If you multiply that, so this is going to be your present value of tax saving, and of course we know that the present value of cash outflow is going to be 1000. So 1067.31 plus 9.97 minus 1000. How much is the NPV you get? If you take a discount rate of 16%, you still get a positive NPV of 77.29, right? So NPV is positive here also. What you need to do, you need to take one more trial that is higher than 16%. What is that? That's going to be 20%. So how do you know? It's given in the question, right? The next trial is 20%. So for 20% discount rate, you arrive at the NPV. It's coming out to negative 29.75. So now you know what to do. So at 16% you get a positive NPV, at 20% you get a negative NPV. You interpolate using this formula: lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into the difference between the two rates of 4%, that is 20 minus 6%. If you do all this, you get an IRR of 18.89%. This is direct formula substitution, no complexities here. Are you clear with this? Right? This is not one of those complicated case study based capital budgeting questions. Pretty much straightforward. It's more computation driven, just like any other capital budgeting question, right? And that's about the IRR computation. And profitability index, so how do you arrive at it? It's going to be present value of cash inflows upon present value of cash outflows at the discount rate of 14% only, right? So now how do you do that? So present value of cash outflow is 1000. What is the present value of cash inflow? It's 1135.21. How did we get this? Very simple. Go above. So the present value of cash inflow is going to be 1124.40 plus you have this present value of tax saving on short-term capital loss 10.81, add plus 10.81. If you add these two, you get how much? 1135.21. That is the figure they have mentioned here. Look at this, 1135.21. that is the figure they mentioned here, divided by 1000. So profitability index is 1.13. Are you clear with this? That's about this question. Nothing great, guys. It's fairly a straightforward question. And with that, we have completed this particular question on your capital budgeting as well. Now, let's move on to the next question, which is the last descriptive numerical problem in this RTP. And this is from the chapter Working Capital Management. Now, guys, please mark the sum as important because it's a very unique sum. Not very difficult, but the wordings could be a little confusing, right? So a similar sum is not there in your institute publication at all. This is the first time where institute has come up with a question of this sort, right? So fairly a simple question, but the wordings could be a little tricky, and I am expecting a similar question or at least one or two adjustments from this question, maybe in your Jan or in your May 25 attempt, right? Now, on that note, let me just read this question for you. Nirmo Limited wants to avail a short-term loan from the bank. However, the bank grants short-term loans by keeping collateral in the form of accounts receivable. So this is a loan against accounts receivable. A bank is analyzing the receivables of Nirmo Limited to identify acceptable collateral for short-term loan. Right? The bank will not accept whatever you say as receivable. They will scrutinize and they will accordingly, on certain receivables only, they will give loans. Okay. The current policy of the company is 3/10 net 40. Means what? Generally, the payable period, right? The trade credit, the period that you are giving to your customers is 40 days. However, if the customer is paying within 10 days, you will give him a cash discount of 3%. This is how we read this, which means what? As of now, the credit term is what? 40 days credit period I am giving to my customer. The bank, they are saying they will lend only to the extent of 90% of acceptable receivables. What is acceptable receivables? Wait, let's read the question fully. At an interest of 12%, only if both the conditions mentioned below are fulfilled, right? The bank will keep a reserve of 5% with a cash discount and returns. Okay, fine. What do you mean by acceptable receivables? Number one, two conditions, both the conditions should be satisfied. Number one, the customers are not currently overdue for more than 5 days to the net period. Means what? Generally, what is the payable? So what is the credit period that I'm giving them? 40 days, right? I need to, the customers need to pay me within 40 days. Now they are saying more than 40 days, which 5 days more than 40 days, or in other words, the particular customer, the particular receivable should not be overdue for a period beyond 45 days. This is what they are saying. If it is overdue for a period of 45 days, against those loans, against those debtors, they will not give this particular loan. This is what they have mentioned in the question. The next one, average aging means what? Payment period of the customer should not exceed 15 days past the net period. 15 days past the net period means what? 55 days means what? Means what? Average aging means average of, so whatever they have taken, average of all the time taken by every single customer in the past. Let's say the customer, to this customer I have supplied him goods, let's say 10 times, right? So every time he takes, let's say 40 in the first sale that I've made, he took 40 days. In the second sale I made, he took 50 days. In the third sale that I made, he took only 35 days, and so on. Now, average of all these past sales that I've made, whatever I average, this denotes the average time that if this particular customer takes to pay me every single time. Are you clear with this? This is the average time taken by that particular customer. That is called as aging. The average aging of that customer should not go beyond 55 days. If it goes beyond 55 days, then the bank will not give them loan at the rate of 90%. They are saying no, 90% of acceptable receivable, that is not treated as an acceptable receivable against which the bank will give loan. Are you clear with this? This is what they have mentioned. Next, if any one of the above conditions are not fulfilled, the bank will lend 65% of the receivables subject to a reserve of 15% at the interest rate of 15% on such accounts. What they are saying, guys, basically what they are saying is, now they have given a list of some debtors and all, some 10 debtors they are given. What you need to do is segregate them into two. First category debtors fulfilling both the conditions. Second category debtors not fulfilling any of the two conditions, right? Against the first category debtors, what they are saying, right? So they are saying some 5% reserve they will keep, reduce 5% on the net amount, on the balance amount, 90% of this they will give it as a loan. This is what the bank says, right? Now, if a particular debtor is not fulfilling either of the two conditions, against that no loan is possible. No, the bank is being more considerate. They are saying against those particular debtor value, you reduce some 15% reserve, and on that amount 65% I will give it as a loan. So even on those receivables which are not fulfilling any of the two conditions, on that also 65% they are giving some loan. Are you clear with this? But at a different rate of interest and all. Are you clear with this? Right? This is what they have mentioned. While we are doing the solution, you will have crystal clear clarity, nothing to worry. Right? The corporate tax rate applicable is 25%. On the scrutiny of all the receivables, the following are acceptable receivables considered for lending. So they have given 10 accounts, right? Amount of receivable they have given. Outstanding in days since invoiced, right? As on date for each of these 10 debtors, how many days it is outstanding, and average aging, which means what? On an average, based on my past experience with these people, let us say debtor 1 on an average he takes 40 days, debtor 2 on an average he takes 48 days, debtor 3 on an average he takes 49 days, and so on. So then what is this 37, 25 and all? Sorry, this is the actual number of days for which it is outstanding. This particular invoice is outstanding for the amount that is lying in the books. That is for this last recent sale that I've made, right? For debtor 1, for this particular sale that I've made, it has been outstanding for the last 37 days. So I would have made some previous sales also, no? And based on my past experience with him, I know that on an average it takes 40 days. Are you clear with this? This is how you need to read this. For debtor 2, this particular sale that I've made, it has been outstanding for the last 25 days. But on an average, this data takes how much? 48 days. This is the meaning of this. You clear with this, right? So then what is that 40 days? That 40 days is the policy of the company. You clear with this? Fine. Now you are required to calculate the total amount lent by the bank, A, and B, the effective interest cost to the company. This is what you need to calculate. Guys, fairly a simple question, right? All you need to know is, the wordings that is given in the question, it could be a little tricky. All you need to know is to decode these wordings and put it very clearly. Now, guys, very simple. Now, what does condition A says? It says that the account shouldn't be overdue for more than 5 days. Correct? It says the account shouldn't be overdue for more than 5 days beyond the net period. Or in other words, it should not be overdue for a period beyond 45 days. Are you clear with this? Now you go to this particular statement given in the question. Now look at those accounts which are overdue beyond 45 days. If you look at this, 47 days. So debtor 3, it's outside. It is out. That is basically for against this particular debtor, against this guy, the bank will not lend you any loan, right? Because it is overdue beyond 45 days. Any other debtor? Yes. Debtor number 7 also, DR7. This guy is being outstanding for a period of 55 days. What is the first condition they have said? Customers are not currently overdue for more than 5 days beyond the net period. So if they are overdue beyond 45 days, against these value, I will not give the loan at the rate of 90%. Correct? No. Fine. Next, what is the second criteria they are saying? Average aging should not go beyond 55 days. Correct or not? Right? Now you look at this criteria. If you see, who are the guys who have an average aging of more than 55? Right? So this guy, that is DR4, and this guy, DR10. Are you clear with this? So DR3, 4, 7 and 8, these 4 debtors do not fulfill either one of the 2 conditions. In that case, what happens here? So against these debtors, the bank will give loan only to the extent of 65%, right? And that too after withholding a reserve of 50%, and that too whatever loan that has been given against these 4 debtors will be carrying an interest rate of 15%. What about the other debtors? Against the remaining debtors, the bank will give a loan of how much? 90% on the value, of course after deducting a reserve of 5%, but these loans will attract an interest only of 12%. This is how you need to read the question. Are you clear with this? So what you need to do is first pick out those debtors who do not fulfill either of the 2 conditions, right? And against them, what happens? The bank will lend loan only at the rate of 65%, that too after reducing a reserve of 15%, and on these loans the interest rate is different. And on the first good debtors, what happens? That is the debtors fulfilling both the conditions, on them reduce this particular 5% reserve, and on the net amount 90% can be lent at a loan, that too at a slightly lesser rate of interest of 12%. This is what you need to do. Now look at this particular question, look at this particular solution. Similarly, for condition B, DR4 and DR10 are not fulfilling. So now what they have done here is, look at this amount of bank lending at 90%, lending at 65%. Lending at 65%, only those 4 guys, DR3, DR4, DR7 and DR10. These 4 guys alone, you park it separately and put it here. And the other guys, the bank is willing to lend at the rate of 90%, right? So the other 6 debtors, the total is 4,54,000, and for these 4 debtors, the value is 2.48 lakhs, right? Now entire amount will they be giving it as a loan? No. First they are saying reduce a reserve, right? This is to precautionate. The bank is going to be very, very cautious. So they are saying out of this, reduce 5%. I'm assuming some 5%. I'm allowing it for some cash discount. No? Some reason the bank says on this 5%, I'm reducing it as a reserve, right? For the first category, it's going to be 5% reserve. For the second category, the reserve rate is going to be 15%, right? So the total minus reserve, this is going to be the net amount, right? And on this net amount, for the first category debtors, what the company says, they are willing to give a loan at 95% on the net amount. 431,300 into 0.95. How much is it? 1 second. 431,300 into 0.9. That is 90% they have mentioned. Yes, lending at 90%. It's going to be 3,88,170 rupees. The bank is willing to lend against those 6 customers who are fulfilling both the criteria. What about those 4 debtors? Against those 4 debtors, the bank is willing to lend at 65%, right? So 2,10,800, 210,800 into 0.65. How much is that going to be? 1,37,020. So what is the total bank loan that you can expect? So sum total of these two. So it's going to be 388,170 plus 137,020. You get a total bank loan of 5,25,190. That answers the first question. Total amount lent by the bank. Clear with this? Very simple. If a particular customer, the debtors, if they are actually complying with both the conditions, right, put it separately in the first column. If they are not fulfilling either one of the 2 conditions, put them in a separate column. Against the first column, reduce the reserve of 5% on the net amount. 90% will be the bank loan. Against the second column, reduce a reserve of 15% on the net amount. 65% will be the bank loan. So sum total of these two figures is going to be the total bank loan, right? But remember one thing, on the first category debtors, the rate of interest will be different. Second category debtors, the rate of interest will be different. That's why they've asked for the effective interest cost in percentage. On the first category lending, 3,88,170. The rate of interest is 12%. Multiply, the total interest paid is how much? 46,580.4. Second category, it is 137,020. On that 15% is the rate of interest. So the amount is going to be 20,553. Right? What is the total interest paid by the company? Add the two, you get 67,133.4. Right? Divide that by the total amount of loan taken from the bank of 525,190. You divide it by 2. But wait, here that will be the gross interest rate. But now they have mentioned in the question, tax rate is how much? Tax rate is going to be 25%. So what you do is 67,133.4 into 1 minus t. That will be the post-tax rate of interest divided by the total bank borrowing. If you do that, the effective interest cost as in terms of percentage is going to be 9.59. Are you clear with this, guys? This is what they have asked in the question. Now it's a very, very unique question. This is one question that has not been present. I have not seen this question anywhere in your institute study material. It's not there in your institute study material. This is the first time they have framed a question of this sort. Please watch out for this particular question as well. And with that, we have completed this question on working capital, right? And with this, I think the entire RTP is done. Okay, fine. The question number 11 is going to be a purely theory question, right? List the emerging issues affecting the future role of CFOs. It's hardcore theory question, directly from your study material. 4 methods of computation of cost of equity. Yes, key 4 methods they have asked for. Yes, you can use your growth model, you can use direct model, you have CAPM method, you have IRR method, you have yield to maturity method. These are basically the methods. Then do the profitability index and NPV criteria of evaluating investment proposals lead to the same accept and rejection criteria and ranking. In what situations will they give conflicting results? Fine. Once again, this is going to be a theory question. So these are the questions. You can just go through it once and leave it there. As simple as that, right? So with this, we have finished the entire RTP of this Jan attempt, right? Jan 25 attempt. And out of this RTP, I would ask you to definitely revisit this question number 3. This question number 3, ideally, I told you this is from Capital Structure Theories chapter. And the last question that we did right now, working capital management. The working capital management, that too, this particular question, please mark it as important. It's very unique. This question is not there anywhere in your study material, right? These 2 questions, in my opinion, stood out of this particular RTP. The remaining questions were more or less the same. And remember one more thing that I told you. There is one mistake in... and of course, sorry guys, before that, there is also one issue in cost of capital where this is not a mistake. They have given discount rate as well as they have given the market price and all. So in this case, the discount rate should be applied on the market price to arrive at the net proceeds. Be very careful on that. This adjustment was also unique. So total 3 unique adjustments. So question number 3, that is on capital structure theories. The last question on working capital management, and in cost of capital here for KP calculation, the calculating your net proceeds. This was also one unique adjustment we saw. And yes, here in this capital structure theories, there was one issue here in this question. Yes, the PE ratio 12 times. I told you there is an error in the solution. Please change that also. But for that, I would rate this RTP as moderate only. It is more or less similar to the questions that we have done in our regular lectures alone. Fine. So on that note, I'm signing off in this video. I will see you all in the next one. Please revisit this RTP definitely before you're attempting your exam, right? So thank you all so much. I will see you all in the next one.